Your top stories. Downshifting gains support. Two current Fed voters back moderating the pace of rate hikes as US data disappoints. European stocks are set to open lower. Tech on the ropes. Amazon and Microsoft begin cutting 28,000 jobs as the industry faces a post-COVID reckoning. Plus, the World Economic Forum continues in Davos with ECB President Christine Lagarde due to speak. We will have live interviews from the CEOs of the Malaysian Sovereign Wealth Fund and Germany's Merck. Let's take a look at the futures then, when bad data, bad news on the data front at least, seems to be bad news for these equity markets. For the first time, it seems, in a long time. Retail sales out of the US falling to a one-year low. Producer prices coming in lower than the estimates, and the open then, as we look at potentially European equities snapping 7 days of gains, futures are pointed lower. The FTSE 100 currently off by 7 points. And of course, you are weighing up the data front, softer on the US side, with the commentary from those Fed voters. Yes, they do expect to see rates continuing to rise and keep and be held at a higher level. But notable that two of those voters suggested you're going to get stepped down to 25 basis points. The market's pricing in a terminal rate of 4.8%. That is away and in contradiction with what we're hearing from Fed officials, even as they view a step down to 25 basis points. The FTSE 100 now down 0.5%. Over in Spain, losses of 45 points, and the CAC 40 down 0.5% as France braces for mass protests. Let's switch it over and see how things then are playing out cross-asset. What a rebound for the Japanese yen. Remember, about this time yesterday, this currency was under pressure, down about 2%. That has all been wiped out. 128 now in the Japanese yen. Further strength. You have the UBS and Schroders continuing to keep their short positions on JGBs, and that is playing in to what we're seeing in terms of the Japanese yen. A reversal there. Currently, strength of 0.5%. Future stateside pointing to losses of 0.2%. And this was fascinating yesterday, watching the yield reaction. A yield move of about 18 basis points lower. That continues today, 2 basis points, 334 now on your US 10-year. That has moved down by a full percentage point since about October, then the highs for the 10-year, the benchmark. Brent currently at $84 a barrel, that's down 0.8%. Again, on those recession concerns out of the US, but also some data around inventories building up in that economy. Pressure then in commodities. WTI, the last time I checked, back below $80 a barrel. So, fresh data out of the US has raised fears that the economy may be moving then closer to recession. Producer prices slid by the most since the start of the pandemic, and retail sales fell, as I said, by the most in a year. However, former US Treasury Secretary Larry Summers told Bloomberg's David Weston he's a bit more optimistic than a few months ago.
I'm still cautious, David, but with a little bit more hope than I had before. Soft landings are the triumph of hope over experience, but sometimes hope does triumph over experience, and we have seen some slowing of inflation indicators. At the same time, we've seen continued strength, and that's got to be what we all want to see.
Okay, joining us now is Joanna Kirkland, CIO and Global Head of Multi-Asset Investment at Schroders. Joanna, good morning. Thank you for joining us. What do you make of the US data and how it informs your views of recession risks in the world's #1 economy?
Well, our central scenario is that we are going to get recession in the United States. So that's very much in line with our view. You know, we've been expecting a weakening of the data. And this is why we've turned more positive on bonds this year. It's really an expectation of this slowdown.
Do you, in terms of the market reaction, and you did have this sell-off in equities and the rally in bonds, is that a theme, that asymmetry, that historical asymmetry, that is going to continue through the year?
Well, I think for now, yeah, we're more neutral on equities and certainly more negative on US equities. We see opportunities in the rest of the world. But I think that there is the potential now for bonds to offer diversification benefits, which were clearly not apparent in 2022. So yes, we would expect that correlation to shift a little bit back to more of what we've seen in recent years.
And we talked about, I mentioned in the market hit there, the disconnect between the markets pricing in a terminal rate of 4.8%. But the Fed officials, even if they see a step down, some of them at least, to 25 basis points at the next meeting, they still expect a terminal rate, most of them, of plus 5%. Certainly rates held higher for longer. That disconnect, who do you think is right? Which side are you aligning with on that?
Well, we think that actually the bit that we're more concerned about is the rate cuts that are priced in for the second half of the year. So, the terminal rate, we're still talking about very small spread. I think we're somewhere in that range. But if you look at what's priced into bond markets, what's interesting is also that there's significant rate cuts started to get priced into the second half, which would imply quite a serious recession and a major turn in Fed policy. And maybe that's one that we're a little bit more worried about. Maybe the bond markets have been a bit too quick to price in that pivot. And certainly that level of concern about growth is not reflected in corporate earnings expectations in the US. So that's where we see the disconnect, or the second half rather than the next few months.
Okay, so that's the disconnect, the pricing in of a rate cut. I wonder what that tells us about your view on the US dollar then. We've seen, of course, the Bloomberg Dollar Index off about 10% since around the end of September. Is there upside risks now for the dollar?
Well, again, I think that the dollar has been attracted to us in recent years because it was positive carry and also because it had diversification benefits at a point when bonds didn't. That was very much the story of 2022. I think now, with the potential to own bonds to provide that diversification, and with other central banks catching up with the States, we're less positive on the dollar. So actually, we're very much aligned with the trends we're seeing this year in the dollar.
A big focus, of course, yesterday, throughout the week, on the BOJ, sticking with its yield curve control policy yesterday. And you talk about the divergence between central banks and the potential opportunities. What are those opportunities as you see them?
Well, there are a number of things going on. I think, first of all, on a more optimistic note, we have turned positive on emerging equities in Europe because, these things are happening quite quickly already in prices. But essentially, we think that the economic outturn is obviously proving to be better than expected in these regions compared to the United States, where, as I said at the beginning, we're more concerned about recession risk. When we think about central banks, I think that there will continue to be speculation about a shift in policy at the BOJ in months to come. And the Japanese yen, again, is an interesting investment because it's quite diversifying in the context of economic weakness. So again, a number of reasons to see opportunities in the Japanese yen, not just because of expectations of BOJ shifting, but also because of our expectations for weakness in the United States. So that's the interesting thing about this year. In recent years, it was very difficult to position for divergence across economies. We were in a world of zero rates pretty much across the board. Well, now we're seeing quite a bit more divergence. And again, the opportunities are therefore following from that.
And you touched on emerging markets and the opportunities you see there. The MSCI Emerging Market Index up about 20% since October. And to be clear, you see that trend continuing. China clearly a factor as well.
China, critical factor. That's really what's been driving our view. The reason why we upgraded emerging markets a couple of months ago is really on that view of the Chinese reopening. And, obviously there's going to be bumps along the way, but if you remember with our own reopening, that was also the case here, but the market looked through it. So we think that is a good position to have in the portfolio. And we also like a local emerging market debt, local currency emerging market debt, because again, the valuations are attractive. We get decent carry from those positions. And in some cases, we have central banks that are further along in the battle against inflation. So quite a shift, because over the last decade, we always favored the US, and actually now we're seeing quite a lot of value in emerging assets in general.
Okay, the value in emerging assets. We'll get more of your calls after the break. Joanna Kirkland, CIO and Global Head of Multi-Asset Investments at Schroders, coming back and getting more of her thoughts in the next few minutes. Thank you. Coming up, Oaktree Capital Management's Howard Marks. He says we have become too comfortable with low interest rates. More from him just ahead. This is Bloomberg.
everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
News breaks. No one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there was a lot else that happened.
1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority. Information you want, analysis you trust. Everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg. Earnings season is here.
Wall Street expecting a bit of an ugly season. People may be overly pessimistic.
We know growth is slowing.
Companies are going to have a lot of questions to answer.
Bloomberg breaks the numbers first.
Tons of banks coming out.
Some of the worst returns when it came to profit. Markets really like that number.
With exclusive expert analysis.
What's your confidence in your outlook?
You got to be selective.
We still see a lot of opportunity.
There is a light at the end of the tunnel.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
With the appearance of the inflation and the increasing of rates to try to stamp out the inflation, things have gotten harder. I imagine people today saying, well, when are we going back to normal like it was 5, 6, 7 years ago? And the important thing to know is that that wasn't normal.
Right.
That was the easiest, the best of times.
Right.
And my own belief is we're not going back there.
Howard Marks, co-chairman of Oaktree Capital Management, speaking exclusively to Bloomberg's Romain Bostick. Let's bring back in Johanna Kirkland, CIO and Global Head of Multi-Asset Investment at Schroders. And let's start with the credit space then, Johanna, and where you want to be exposed. How much risk do you want to be taking on? I'm looking at high yield. US high yields had the best start to the year since about 2009. Do you expect that to continue? How much risk do you want to be taking on within the credit space?
Well, actually, we were positive on US high yield, but took profits just because, again, we're getting more concerned about recession risks and we wanted to reduce some of the cyclicality in credit. So right now we're favoring European investment grade debt. It's higher quality and less exposed to, again, some of those trends that we're seeing in the United States. So ultimately, it is important, I think, to earn that yield. But we are opting maybe for higher quality, more defensive allocations compared to where we were 3 months ago.
And before the break, you touched on the earnings picture and the fact that you expect to see further revisions in earnings as that data comes through. Which sectors do you see as most exposed at this point?
Well, I mean, we don't focus on the specifics of the sectors. I think it's more about the downturn in the economic environment. So we'd be most concerned about the more cyclical areas of the market in the United States. And ultimately, we don't know if tech is out of the wood. I mean, clearly it got hit very hard by rates going up last year. But again, you know, there's evidence of weakness on that front as well. So I would say fairly broad-based on the corporate earnings.
When it comes to the Eurozone, and I know you think that there's a little bit of opportunity there, and we're hearing increasingly from policymakers and economists that maybe the Eurozone escapes a recession. And yet we have the hawks within the ECB pushing back against this narrative that maybe they step down in terms of rate hikes. We have that again today with Klaas Knot saying that 50 basis points, multiple 50 basis point hikes should be expected. How do you square that view with some assessing that maybe there's a little bit more resilience to this Eurozone economy and how that feeds through into the corporate space?
Well, I mean, the reason why we like European equities is just they've got very cheap. You know, we're really looking for opportunities to take advantage of valuation. Now, from an economic standpoint, right now we're getting some reprieve because obviously energy costs are proving to be lower than people were expecting. But, you know, we do believe the ECB will be raising rates. Again, this is coming back to the point I was making earlier about diverging trends around the world. And again, Europe is having to still catch up with what the US has done in terms of rate increases. Ultimately, I think that in some sense, rates going up in Europe is a positive development because the environment we've been in over the last decade of rates pinned at negative yields was ultimately symptomatic of a very challenging environment for the European economy and also a big problem for the financial sector in Europe. A return to positive yield ultimately is a return to normality and I think a welcome adjustment. We'll have to be careful, you know, obviously, again, Europe has outperformed quite a bit relative to the United States now, so we have to keep an eye on our positions. But I think that ultimately this is all sign of the fact that Europe is having a decent recovery.
Okay, that's really interesting. And tying back to Howard Marks's comments then, and he was telling our team there that he expects default rates to get back to a traditional 4% level. He says they're about 2% now. In terms of corporate Europe in a higher rate environment, the resilience there, and do you expect to see a step up in defaults or can they weather this?
We think they can weather this, but I would agree in general with his comments that, you know, we're not going back to the regime of the last decade. You know, the last decade was very unusual, the zero rate environment. We're moving back to a normal rate cycle, which again is a healthy development. But that also means that the era of easy money is over. So I would generally agree with his conclusions on the way in which the regime is shifting. We're completely in agreement on that.
You talked earlier about the role that China will play in terms of supporting EM through the year. How else do you want to play that reopening theme? Is there further to run? Do you want direct exposure to China, or do you want to play it through, for example, the luxury space in Europe?
We've been doing it via direct exposure. We think that's the cleanest way of doing it. You know, whether then our stock pickers want to focus on opportunities in the luxury goods sector, that's really up to them. But from a top-down perspective, given the fact that China went into a bear market before everybody else, again, the valuations were cheap, there were a number of headwinds, I think, you know, there's room for a continued rally in the Chinese market. So we're expressing it directly.
Are you concerned? Is there a level of concern about the inflation impulse out of China?
Yes, I mean, I think it comes back to, I think, right now we're in an environment where inflation is falling in the West, the year-on-year effects, which are helping us. Ultimately, we think the labour market also will weaken. But again, we are in an environment, as I said earlier, we're not going back to the period of the last decade where inflation simply wasn't a problem. I think that generally inflation is going to be somewhat structurally higher. So I could sort of see an environment where this year we sort of position for falling inflation, but then ultimately we're then back to worrying about it as we head into 2024. And certainly the Chinese recovery could be part of that story. You know, generally the number of trends that are pointing to inflation being higher than it was in the last decade, which again, as Howard Marks was saying, was actually the aberration. The last decade was what was unusual. We're returning to a more normal environment for inflation and for rates.
Just briefly before we let you go on the prospects for the UK, Johanna, we have of course had the FTSE 100 outperforming last year, many of the major indexes. Do you expect that outperformance to continue?
Well, we did have a position overweight UK equities. We did take profits on it. We had against the tech index. So, you know, it was a very extreme position that did very, very well. So we banked some profits there. But generally, again, the FTSE does offer attractive valuations. It has more of a value orientation in its index composition, which in an environment where, you know, a rate cycle is back, I think is quite helpful. It also has defensive characteristics. So generally, I think it is still an interesting market. It's just that, you know, in this environment, again, we are trying to sort of bank the profits when we see them. So right now we've taken a bit of profit. But generally, I would say that compared again to the last decade when the UK was just a chronic underperformer, it's a much more interesting market in this market regime.
Okay, Johanna Kirkland, CIO and Global Head of Multi-Asset Investments at Schroders. Thank you very much indeed on the prospects of opportunities around diverging stances from central banks and also within the EM space. Also a call there on investment grade within Europe. Some resilience for the European economy is the view there. Thank you very much indeed. Coming up, strikes sweep France over the government's plans to overhaul the pension system. We'll have the latest live from France. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to the Open. We are 21 minutes into the European trading day. Losses of almost 0.6% across the benchmark after 7 straight days of gains for European equities. Futures in the US down by about 0.1%. Again, as investors adjust to prospects of a recession in the world's largest economy. That data on retail sales and producer prices coming in lower than expected. Retail sales falling to the lowest in a year in the US. 2 Fed officials saying that you could see a step down to 25 basis points. Let's zero in on a couple of the individual corporate stories for you. It is earnings season, of course, and you had some pretty soft numbers coming through in the forecast for Boohoo, the online, of course, fashion retailer, suggesting that you could see revenues fall by about 12% this year. They are very much focused, they say, the executive team, on cost cuts, given the conservative nature of the consumer here in the UK. You can see a price drop, of course, a drop, I should say, in the shares of 5%. BHP, very different picture in terms of their prospects, at least in terms of production of iron ore and the demand out of China. They actually saw a record in terms of iron ore production in the first half, and executives at that company saying they expect China to drive commodity demand in 2023. LVMH, just a little fun story there on the fact that champagne sales out of France, 6 billion euros for the first time in terms of demands, export demands, a really central catalyst there. Total shipments of 326 million bottles. LVMH, of course, within its coterie of products and brands. Dom Perignon, Moet and Veuve Clicquot. Currently that stock down 0.7%. Talking of France, French unions are taking part in a nationwide day of strike action. The government's plans, against the government's plans to revamp the pension system. Let's bring in Bloomberg's Caroline Connat then in Paris for more. Caroline, what do we know about the disruptions that are likely to impact France today?
Tom, it is the first day of the general strike against this pension reform announced by Emmanuel Macron last week. And it is, according to the transport minister, going to be a very painful day for the French. We expect disruptions in public transport, in schools, in hospitals, oil refineries, or even nuclear sites. To give you some example, for the TGV high-speed trains, there will be 1 in 3 maximum across the country. Some metro lines will be totally closed, some only open at rush hour. For those who have children, it is a very difficult day as well, because 70% of primary school teachers are striking today. To give you an example, for example, in Paris, at least 1/4 of the schools are completely closed. In other schools, there will be a minimum service for those who cannot do without having their kids at school. So a lot of disruptions also in oil refineries. 1 day of strike. The CGT has one for more strikes in oil refineries. So you already have some French who have been queuing to fill their tanks because they have been traumatized by the last refinery strike last fall. And finally, so in terms of electricity production, the CGT union has said that there will be reduced electricity production today, equivalent to about twice the consumption of Paris. And finally, this afternoon, of course, everyone will be protesting, marching in the streets. I'm going to go check out the protests in Paris this afternoon, and unions are targeting at least 1 million people in the street.
At least 1 million people in the street. And this is coordinated action between the unions. And as you say, and as you illustrate, across multiple different sectors. This was their threat before this reform was announced. What does it mean for Macron? Will he back down?
It really depends on the numbers, actually. So if there are more than 1 million people in the streets today, it will be a victory for the unions. If it is less, it will be a victory for the government. But when you think about it, about 2/3 of the French people are opposed to raising the retirement age, but that doesn't mean that everyone will, of course, descend in the streets and protest. So really it depends on whether there are a lot of this opposed to this reform actually descend on the streets, whether you will see more strikes over the next weeks and months. You know, in the past, a lot of French presidents have actually tried to reform the pension system. Some of those have succeeded, including Nicolas Sarkozy, for example, who managed to rise the retirement age in 2010 from 60 to 62 years old, but some have failed, and the most famous example of all is 1995 under President Jacques Chirac. You had so many people in the streets, more than 2 million for 3 weeks, that the government had to back down and abandon his pension reform.
Okay, a very real standoff. Caroline Connard on the ground in Paris. Thank you very much indeed. Coming up, we are going to be live in Davos, of course, for the World Economic Forum. And do not miss our interview with the managing director of Malaysia's sovereign wealth fund. That is next. This is Bloomberg.
So now you've been at JP Morgan for about 25 years?
Yes.
Okay, so, and now you run one of the most important parts of JP Morgan, which, as I say, is the asset and wealth management business. What actually is wealth management, and how is that different than asset management?
Great question. The two are often used interchangeably, but they have distinctions. The asset management business is where we manage money on behalf of individuals, institutions, sovereign wealth funds, pension funds. We manage them in mutual funds, we manage them in ETFs, we manage them in single stocks, single bonds, hedge funds, private equity, and the like. And that is the heart of the fiduciary business that we run here at JP Morgan. Wealth management is that plus understanding someone's entire balance sheet. So for the individuals where we manage money, we also help them with their mortgage. We help them with a loan that they might need. We help them with their basic credit card. And so wealth management is trying to help someone with their entire life, both their assets and their liabilities, their planning, their gifting, the legacy that they want to leave for their families, the 529 plans they need to prepare to get their kids to go through college. And it's a great insight into people's, entire journey.
Welcome back to The Open. We are 30 minutes. Here are your top stories. Downshifting gains support. Two current Fed voters back, moderating the pace of rate hikes as US data disappoints. Stocks point mostly lower. Tech on the ropes. Amazon and Microsoft begin cutting 28,000 jobs as the industry faces a post-COVID reckoning. Plus, the World Economic Forum continues in Davos with ECB President Christine Lagarde due to speak. We are going to be joined by the Managing Director of Malaysia's Sovereign Wealth Fund in just the next few seconds. Let's check in these markets then before that important interview. And you are seeing selling pressure down 0.5% across the European benchmark. The DAX is off by 77 points. Here in the UK, the FTSE 100 down by 0.5%. You did have the Europeans in terms of the ECB officials. It seems the hawks within the council, their feathers have been ruffled by the reporting from Bloomberg suggesting that officials within the ECB are considering a step down to 25 basis points. Oh, no, says Villeroy of yesterday. And today, Klaas Knot over the the Netherlands, saying that's not going to happen. We're going to get multiple 50 basis point hikes. That's giving a bit of an uplift to the euro and certainly replaying, or at least making investors reconsider the rate hike trajectory for the ECB. Let's have a look at how things are playing across the sectors then. The data, yes, soft out of the US. The pendulum swing in terms of the focus, arguably, from inflation to those recession risks. Across the sectors then, in Europe, food and beverage just gaining 0.1%. Two sectors in the green, everything else in the red. Energy down a full 2%. And you'll look at Brent and WTI under pressure, again, on those recession risks out of the US, but also the inventory buildup in that economy as well. Let's get back to Davos, though. Business leaders, of course, at the World Economic Forum in Davos are discussing the outlook for the global economy. Bloomberg's Haslinda Armin is standing by live with a very important guest. Good morning, Haslinda. You're almost at the finish line.
Almost there, but not yet. Tom, thank you for having us. And of course, we're talking investment strategy now. 2022 was about QT, quantitative tightening, and 2023 is about living with that tightening. Well, Faisal Wan Zahir, Managing Director of the Malaysian Sovereign Wealth Fund, Khazanah. It has $30 billion in AUM. Let's get insights, perspective. Faisal, good to have you with us.
Thank you. Thanks for having me.
What opportunities are you seeing at the current environment with quantitative tightening and lots of uncertainty in the global economy?
Well, good thing is we're actually long-term investors, so that's a good start. But when you actually look at it, there are actually some fundamental changes as a result of what we're seeing today. Now, when you look at the QT that's happening, it's really coming out of the pandemic. And there's a couple of things that have come to light. So, for example, if you look at geopolitics, if you look at food security, energy security, et cetera, that becomes more important in everyone's agenda. So reshoring becomes a very topical theme, actually, for investments. The other thing that we are seeing is climate change as well is also an opportunity. And I think as long-term investors, we have partners in the GPs and private equity, for example, which actually take a longer-term view than the volatility of the private markets. So themes such as trying to look at areas where potentially could improve, the green environment, the climate environment, looking at manufacturing in those sectors as well. So those are areas which actually is quite interesting.
You talk about reshoring, onshoring, friendshoring, yes. And automatically you think about markets like India, Southeast Asia. So are these the markets you're focusing on in 2023?
Yes, I think India is a great example for us because, they've seen a lot of growth. Valuations are high, but it will always be high. Southeast Asia is perhaps one region where it's very, very interesting from private markets as well as public markets because of valuations, because of opportunities as well. So I think, yeah, those emerging markets, those would be areas.
Valuations in which sectors in particular?
I think when you look at the potential for PE multiples in whether it's Indonesia, whether it's in Vietnam, etc., those are actually quite interesting. Malaysia as well is very attractive. I think there's a lot of potential for Malaysia. So yeah, those are the areas we're looking at.
2023 is also about China's reopening. What opportunities do you see there? Valuations are very, very low, but also they come with risks. True. Still.
Yes. And we hear good things coming out of China. We hear that when it comes to regulations, understanding the need to be transparent and consistent is important for market, being a bit market friendly. So we do hear that. I think what the market is perhaps a bit cautious and looking to see how this will pan out. Valuations are attractive. You're looking at Consumer is still there, but you're looking at hard technology and industry as well. So it is attractive, but you have to pick and choose. We're already exposed there, so this is,
You're already exposed. Will you build on that exposure? And if so, where?
I think private markets, we would be looking at that. Again, when you look at the manufacturing segment, when you look at pharmaceuticals, the technology sectors, there's still opportunity.
Malaysia has seen 2 years of slowdown, and of course, there's been a lot of pressure on companies like Khazanah to boost local growth by investing locally. How are you balancing domestic and international investment?
We do that by creating funds so that we're actually disciplined and focused on what we do domestically. We're also focused on what we do internationally. So we created an impact fund, a 6 billion ringgit fund, which we started last year, and we're beginning to look at opportunities and deploying it. And that is focused on domestic. Sizable sum looking at catalytic growth areas. We also have a development fund, and this is where we have investments in the southern part of Peninsula Malaysia, Johor. Again, we're looking at how to realize value there. So there's a lot of investments focused on domestic expansion. And at the same time, we have the investment portfolio, and this is where we look at commercial returns. This is where we look at trying to achieve our strategic asset allocation, manage the risk because we're long-term investors in order to get that return.
Doing well in terms of investments in the country?
The investments in the country is still about 60-odd%. Now, that's something which can be improved further. And we're focused on that, actually. We're really focused on trying to make sure that the companies that we're invested in create value creation opportunities. Look at the balance sheets. Some balance sheets are a bit lazy, improving their return on equity. Looking at their businesses and see how they can unlock it. I'll give you some examples. CIMB, as you know, which is a bank that we are invested in, they've done well in managing their costs. They've done well in looking at their ROEs. Axiata recently merged, Celcom recently merged with Digi. That's an example of unlocking value. So that's another focus that we would like to see, and that will create value for the country.
International investments account for about 30% of your portfolio. I know that for the longer term, you're looking to build to perhaps 60. In fact, in 2019, your predecessor said perhaps 60 to 70% international exposure within 10 years. What are your own targets?
Well, the targets are there, and that's part of the
What is that, 60%?
60%, but of the investment portfolio. So this is why I want to be clear. We have an investment portfolio where we need to diversify, but if you add on the impact fund, if you add on the development fund, then that number for domestic becomes much larger. But it's okay because we're investing in the country for the long term, and that's what we need to do.
You're invested, of course, still in Malaysia Airlines, a national carrier, has been settled with all sorts of problems. And of course, the company has been looking for buyers, partners, what have you, all the options on the table. What's the latest?
The latest is, well, never waste a good crisis, and they took that to heart. Why I say that is because the first thing that they did during the crisis was to fix the balance sheet, make it more resilient, more equity rather than a lot of debt. The next thing that they did was they really looked at operations and reduced the fixed cost element and made it more variable, and get rid of all the fat, which they have done. And then after that, focusing on yield. So we committed a lot of equity to make sure that it survived. I think in 2022 was a good year for them. They managed to taper the cash burn. In fact, I think they're in a good shape right now. So the focus now is on experience and getting a sustainable business. That first, before we think about partners.
But are you considering still of disposing your stake in MES, Malaysia Airlines, despite the fact that it is in a pretty good fiscal position right now?
That is always an option, but I believe we want to make sure we have a very good, sustainable airline, and it's easier when we want to speak to anyone anyway.
The biggest risk for the investment, I guess, for investors in 2023 would be, is it still the fad?
It is. Unfortunately, it's the global markets. It's everywhere. It's global recession, yeah.
Welcome to the new world, the new normal of uncertainty. Amirul Faisal Wan Zahir, CEO of the Malaysian Sovereign Wealth Fund, Khazanah Nasional, and its managing director. Tom, handing it back to you.
Haslinda, great stuff. Thank you very much indeed. Talking about the opportunities there in Southeast Asia and India. A little bit more cautious, it sounds like, on China. Haslinda Aman, of course, on the ground with the CEO of the Malaysian Sovereign Wealth Fund at the World Economic Forum. Coming up, cash bonuses. Credit Suisse attempts to incentivize staff to stick around as the bank undergoes another restructuring. More on that next. This is Bloomberg.
much of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back to the Open. Happy Thursday, 42 minutes into your European trading day. Losses, though, across the European benchmark of close to 0.6%. The data out of the US looking weaker. The focus then on recession risk. Here in Europe, the ECB's class not pushing back on the idea they're going to get a step down lower in terms of rates, saying we should expect multiple 50 basis point hikes from the European Central Bank. The futures in the US, the S&P E-mini is pointing lower by 0.2%. Let's get the Bloomberg First Word News now with Laura Wright. Laura.
Thanks, Tom. The Total Energy CEO is urging French motorists not to panic buy fuel ahead of strikes over a government plan to overhaul pensions. Diesel and petrol deliveries are set to be paused as part of a 24-hour walkout across France today. The strikes are expected to disrupt everything from energy production to manufacturing as labor unions protest President Macron's plan to increase the retirement age. New Zealand's Prime Minister Jacinda Ardern says she's stepping down in a surprise resignation ahead of a general election later this year. Ardern, who was the world's youngest female leader when she took power in 2017, says she no longer has the energy or inspiration to seek a third term. Her ruling Labour Party will hold a first round of voting for a new leader on Sunday.
I know what this job takes, and I know that I no longer have enough in the tank to do it justice. It's that simple.
Microsoft and Amazon have begun cutting a total of 28,000 jobs, part of a post-pandemic reckoning for the tech industry. Microsoft has started notifying some of the 10,000 workers that will lose their jobs this quarter. The 18,000 job losses at Amazon represents about 6% of the online giant's workforce. Both companies say the cuts are needed to offset slowing sales. English football clubs have cemented their position as the leading revenue generators in Europe. Manchester City took the #1 spot in Deloitte's annual Money League for a second year running, with 5 more English clubs filling out the top 10. Man City's revenue, up 13% last year, was boosted by a sharp increase in commercial income. Liverpool and Manchester United also made the top 5. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom.
All right, here in London, thank you very much indeed. Let's get back to the banking sector then, and particularly the question around pay and bonuses. Credit Suisse will now pay its senior bankers an upfront cash award, and that's, again, this year. This is the bank, of course, attempts to incentivize its staff to stick around as it undergoes a broad restructuring.
Yeah, and clearly, last year was a tougher year than the year before when compensation was higher, and it's a cyclical business, and our compensation will continue to follow that trend.
Okay, let's bring in Bloomberg's Charlie Wells for more on this. Charlie, will the incentive scheme by Credit Suisse, will it actually work to hold on to that talent?
You know, Tom, not necessarily, especially if we look at last year. So Credit Suisse offered a similar bonus to senior staff last year, and they still saw a significant stream of departures, particularly in Asia. Now, that's not necessarily surprising given the fact that Credit Suisse had a very difficult 2022. They're undergoing a restructuring. The chairman even said it was a horrifying year. So look, this is a difficult calculus for bankers to make. Do they take this short-term cash infusion and stay at a bank which looks like it has some difficult times ahead, or do they try to go to a different employer? And I was talking to a recruiter last week who told me there's still jobs out there. I mean, Bloomberg had a story recently about how HSBC is actually sending recruitment emails to bankers at other banks that have been laid off.
Yeah, a cheeky and maybe creative move there by HSBC. So we've had a lot of news come through from the banks. Just give us the overview then on where things stand in terms of hiring and in terms of bonuses.
It's really striking and it's confusing. And look, that recruiter I was talking to said it's not all doom and gloom. There are still jobs out there. And you see sort of a mixed bag. So when you think about Citigroup, yesterday we had a story about how they're actually offering bonuses to junior staff. So differing from the Credit Suisse there, where they're focusing on giving more money to junior staff. But then we also had news that Bank of America is actually effectively bringing in a hiring freeze. There will still be some hiring in key areas that are bringing in revenue, areas like wealth management and that all-important tech group for these banks. And JP Morgan said that bonuses will absolutely be worse this year. So there's sort of a mixed picture, but it's looking like a lot of that discretionary compensation is going down. But it's tough for banks because they need to keep staff, they need to invest in their operations while still keeping expenses low.
So it's a very mixed picture, isn't it? What does this divergence tell us about Wall Street and the fortunes of Wall Street?
Look, I think anyone who says right now is the same as the financial crisis as far as those huge layoffs is probably overstating the problem, because there is still hiring, and banks actually are planning to spend $183 billion on compensation and personnel this year, which is a lot of money, and it doesn't indicate that they're necessarily, going to lay everybody off, because if they do that, they really don't have a forward-looking plan, and they need to do that. So they really are planning for a time when growth will return. The question is when that actually does happen.
Okay, $183 billion in terms of compensation. As you say, still a significant number, and good to hear that hiring is still an opportunity, something of a silver lining as we face up to these job cuts. Thank you very much indeed, Charlie Wells, for the latest, of course, on compensation, bonuses, and hiring across the banking space. Up next, the global bonds bonanza. The best start, this is remarkable, the best start to a year for bond returns. It's helping fuel an unprecedented debt sale bonanza. We will bring you all the details next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
can ESA help humanity take its next giant leap?
Information you want, analysis you trust. Everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
Welcome back to the Open. The sell-off across European equities becoming more pronounced now, down 0.7%. Just a sharp leg lower just in the last few seconds as well. Futures in the US lower by 0.3%. You've had the ECB's Klaas Knot saying that you should expect from the ECB a series of 50 basis point hikes going forward, pushing back on some reporting out of Bloomberg that some officials within the ECB are looking at stepping things down in terms of rate hikes. And of course, the weaker data out of the US, particularly retail sales, falling to a one-year low, suggesting that recession risks are becoming more acute. Here in the UK, the FTSE 100 down 0.6%. The euro getting a little bit of a bid on those comments from Klaas Knot, up 0.2%, and the pound is 1.23. Across the energy space, that's where a lot of pain is being felt today as well. Brent down 1.2%, WTI off by 1.4%. Let's take a look now at some of the events we are following today. At 10:30 a.m. UK time, ECB President Christine Lagarde is due to participate in a panel at the World Economic Forum. Really important, given the tug and pull between the hawks and the doves within the ECB that we've seen play out over the last few days. At 12:30 p.m. UK time, the ECB is going to publish the account of its December policy meeting. That's followed by US initial jobless claims, of course, the importance around the tightness in the labour market there. Then the ECB's Isabel Schnabel and Fed President Susan Collins, they do to speak at separate events. That's 2 p.m. UK time. And finally, we're going to hear from two of the most influential FOMC members, Lael Brainard, of course, the vice chair there, and John Williams speaking tonight. Now, the best start to a year for bond returns is helping fuel an unprecedented debt sale bonanza by governments and companies around the world. Global bond sales have hit nearly $600 billion in 2023 so far. What are we, January the 19th? Wow. Okay, for more, I'm joined by Bloomberg Markets reporter Valerie Teitel. Valerie, all of last year, the question was, who's going to buy these bonds? And that dynamic has changed, and changed pretty radically.
Yeah, changed very quickly, and it turns out everyone wants to buy these bonds. Investors globally are gobbling up this issuance. You know, we're seeing this record issuance alongside a bond rally that's really showing us the strong demand that's behind these deals. Yields are tasty, and investors don't want to miss out on after such a long era of low yields. And look, I think they're probably looking ahead, seeing that we're pricing in central bank cuts later in the year. Investors are really keen to lock in these high yields while they can. And look, perhaps the best place to hide out if we do see some global economic downturn is in these bonds.
Tasty yields, yeah. Yields of what, 5% on some of these portions of the debt market look pretty attractive when PPI is coming in a little above 6% out of the US yesterday. Take us through and talk us through where that issuance is coming from.
Yeah, so in Europe, financials have had a hefty amount of issuance, but the region as a whole saw its biggest week ever, up 40% from last year. Asia, there's a decent amount of corporate dollar bond activity that's alongside, you know, China reopening narrative. People are very willing to invest in Asia. EM sovereigns issuing in both euro and dollar denominated debt. Now listen to this, Tom. So far, the issuance from EM equals 40% of the entire sales from all of last year. And as you mentioned, it's only been 2.5 weeks in January.
So EM really taking advantage.
Definitely. Let me just rattle off some people have come to the market. Saudi Arabia, the biggest emerging market sovereign debt deal in almost 3 years. They issued $10 billion. Hong Kong, Hungary, Israel, Mexico, Turkey, Mongolia, and there's a few others in the pipeline. EM is really having a blast.
Any sector that isn't looking so strong?
The one sector that is lagging is high-yield corporates. Now, in terms of issuance, they really took advantage of the low yield era to extend the maturity of their debt profile. So they don't necessarily need to come to the market at the moment. They might as well wait, maybe be patient for later in the year if we do see yields decline, where they could borrow at lower rates. The other one that's been soft is Japanese corporates. Again, that's not surprising. Their deal flow has plunged 70% versus last year, but we've had a lot of tumult, especially especially in the sovereign bond market, as the BOJ looks at their yield curve control and liquidity in the sovereign market dries up. It's not surprising that corporate does as well.
So high yield and Japanese corporates not issuing as much. When it comes to default rates, though, we heard from Howard Marks saying, look, the normal is 4%. We're at about 2% now, but he thinks we get back to 4% in terms of default rates. That's a risk.
It's definitely a risk, Tom. It's definitely a risk. But look, I think investors are seeing these level of yields. They understand that risk reward, but it's still attractive even with those downside risks in mind. But you're correct. Profit margins for both IG and high yield have declined. That I guess elevates the risk of some sort of a default risk that you have to bake in there. But you know, maybe it is the calm before the storm. If we have a hard landing in the later half of this year, we could see default rates spike, but investors at the moment see these yields and want to gobble them up.
Taking advantage. The question is, how big is that window and how long is that going to be kept open? Valerie Teitel, fantastic breakdown there of a really important story. Thank you very much indeed. Just briefly, before we let you go, across the sovereign debt market, you're still seeing treasuries bid, yields down 2 basis points, but the context was you saw an 18 basis point move lower across the benchmark yesterday, 353 on your US 10-year. Equity markets here currently now down 0.8%. Futures lower by 0.4 on the S&P E-minis. That is it for the European market open. Surveillance, early edition, is up next. This is Bloomberg.
Humanity consumes 500 billion cups of coffee every year. That's almost double what we consumed a decade ago. And yet, coffee production is one of the most antiquated industries in all of agriculture. Climate pressures like drought, heat, and blight are affecting food producers in different ways all over the world, as climate change becomes something we can taste. In the past year, hundreds of thousands of acres of coffee plantations were wiped out. What's at stake are the livelihoods of around 125 million people. Because, if you're being honest, this is a plant that cannot hold on much longer in a changing climate.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here, live from Davos. Now, we have some fantastic interviews from Davos this hour. In a moment, we'll be speaking to David Rubenstein, the co-founder of the Carlyle Group. A little bit later on, we'll also be joined by the Chief Executive Officer of Germany's Merck, Belen Carrillo. But now we're getting some breaking news out of Norges. This is the Norwegian Central Bank. Of course, this is extremely important because it gives us an indication of what the markets are expecting. Now, pretty much as expected, actually, that interest rate 2.75, the estimate was 2.75. So for a roundup of that impact, that market interest rate decision on the markets and beyond, let's get straight to our Danny Berger in London. Hi, Danny.
Hi, Francine. It is this mix of trying to digest what central banks will do from here on out and what the economy is doing. We are still in quite the risk-off mood considering yesterday's data in the U.S., both those retails and producer sales. So that means European equities, those are lower by 0.8%. And we still have bond buying in full force. U.S. 10-year yields now for the second day, there is a rally there, which means yields have fallen by a cumulative 22 basis points. And demand concerns, that means oil is on the back foot this morning, down 1.33%. And finally, we are seeing a pop in the euro. It has started the day lower, but Knot, of course, the ECB member, was speaking about an hour and a half ago, saying that he sees multiple point hikes. Of course, there had been that Bloomberg scoop that some members were considering just 0.25% moves for the ECB. So some readjustment going on this morning, Francine.
Danny, thank you so much. We're also getting some breaking news out of CNOOC. Now, this is the oil giant, of course, of China. It's not surprising given what we've seen in terms of the last 12 months because of the war in Russia, or the Russian war in Ukraine, the impact of the price of oil. And on the back of that, CNOOC is expecting a 2022 net income to increase about 99 to 104%. This is year on year, and of course it's just to do with the increasing huge demand for some of the fossil fuels that we were trying to phase out, now really back at the forefront, the strongest story for 2022. Now, UniCredit's chief executive says he's expecting Europe to avoid a recession this year, but he's also warning that several risks could still derail the outlook. Well, I spoke to Andrea Orcel a short time ago.
I think there is a danger because we look at the last time there was inflation, and many were still at school at the time.
No one can remember it.
No one can remember, and the economy, the interrelation on the economy, what is generating the inflation is very, very different. And as I said, we are, well, take Europe, we're going from -50 to potentially 3 in the space of a year and something. So how do you assess the real impact on balance sheets and on payments of families and corporates? Is different also because if they have medium-term loans, they haven't rolled their loans yet. And as they roll, you will see more of the effect. So that's quite complicated to see what the impact is.
So for example, what does that mean for NPLs in Italy, and how do you address?
Look, I think we are all in a situation where we see the problem, we see the uncertainty, we all anticipate a potential shock. But if we look at our indicators, they're all very good. I mean, the stock of NPLs is going down still, and the cost of risk is still compressing. And we had a slower October, November, but from December, the pace, both in the corporate sector and at family level, has increased.
So you don't see that accelerating, actually, this year? Again, you don't see a kind of delayed impact of some kind of shock?
It depends very much on where we're going to land in terms of rates, inflation, and GDP. At the moment, UniCredit felt that we were going to have a shallow recession this year. At the moment, we would tell you that we're going to have potentially a 0 to slightly positive economic growth in Europe. Now, there is a lot of risk, the geopolitics, the war, the value chains, how much the interest rate increase is going to hit the economy. All of that are risks. But if we look at the indicator today, we're not going to a recession. We're going to stay on a flat. And even inflation, our view is that we're going to have an average of probably 6% for the year, but the exit rate is going to be closer to 3%. So if that happens that way, then that is quite good news. If it doesn't, we need to be prepared for a shock, but we don't know.
So that means what? Extra provisioning? Extra cleanups?
Well, we have taken the view of managing for what we see, i.e. relatively optimistic, but taking big buffers in case we are wrong. So we've created overlays over normal provision. At 9 months, we were already 1.3 billion and indicated we would increase them further in the fourth quarter. And that for us is saying, okay, the business is going like this and we're managing that way. But if we're wrong, I have a big buffer equal to 1 year of cost of risk to complement whatever hits me.
Well, that was the UniCredit Chief Executive Officer, Andrea Orcel. Now, amongst the guests we're speaking to at the World Economic Forum in Davos, the Chief Executives of Morgan Stanley and Bank of America, also the Director General of the World Trade Organization. But coming up, don't miss our interview with David Rubenstein, the co-founder and co-chairman of the Carlyle Group. A good conversation on private assets. That's next, and this is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Hello traders, how are you today? Long time not seen. I'm going to place order to buy Bitcoin. The price I'm looking to buy, actually the price right now, the price is 20,760. Okay, I'm placing an order to buy at this level, and let's see what's going to happen with when I'm going to get filled. It probably will be any second right now. That's it. Position open on Bitcoin. If you want to follow my trades, please place your order and follow me, stay with me, and we will close this trade together. Okay, otherwise you can get the strategy at company.co.uk. Or you can register for webinar. I provide webinar, live webinar. You can ask any questions you like. So I will try to answer to all of your questions. Okay, stay safe, and I'll speak to you later.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Davos. Now, the Chief Executive Officer of Goldman Sachs International says the bank will continue to hire new staff selectively. I spoke to Richard Noddet earlier.
We've sized the firm, to suit what we think the outlook will be. But of course, you have to be nimble, and I think it's important, particularly in a cyclical industry, in our industry, we continue to adapt to the environment. But looking ahead, we think we've got the firm to the right place now. I think importantly, we're going to continue to hire a lot of people. We're hiring over 3,000 people from universities this year, so we're going to bring a lot of new people into the organization. We'll selectively hire up and down the organization. So these cuts help us drive greater efficiency, help us size the footprint. Clearly, there's been some adjustment across some of our consumer-facing platform businesses, and so we think we're set. But we will continue to adapt to the environment as it unfolds.
Richard, what about compensation?
So we always try and match our compensation and the rewards for our people to performance. And last year was obviously a tougher year. We're very focused on driving returns for shareholders. We drove a 10% plus ROE for shareholders last year. But compensation and rewards for our people have to reflect overall performance. And clearly, last year was a tougher year than the year before when compensation was higher, and it's a cyclical business, and our compensation will continue to follow that trend.
So how much will bonuses be cut? And actually, do you think staff will take it badly?
I think our people have a long-term view. They're here to build a career, and they know that it's a cyclical industry. I think over time, it still offers terrific returns for our people. But you have to take a long-term view, and you have to look through the cycle, and you have to form a view as to what do you want your rewards to be over a cycle as opposed to any single year. And there'll be good years and there'll be less good years, but history has shown that you stick with it over time, you do very well.
Well, that was Goldman Sachs International Chief Executive Officer Richard Nande. It's extremely interesting here in Davos to listen from various industries about, of course, not only the supply chains, but the reopening of China. I think my big speech here in the last 2 days, well, actually two big speeches. First of all, we heard from the Vice Premier, Liu He. He talked a lot about the reopening. He then traveled on to Zurich to meet with the Treasury Secretary, Janet Yellen. The other big speech, and he's the only G7 leader here in Davos, is Olaf Scholz with a message of optimism about the resilience of the German economy. I've had a couple of guests today saying, look, yes, we can be proud of what we've achieved, but it's going to be still a long, long road ahead, and it's maybe too soon for Germany to cry victory. Now let's also get to the Bloomberg First Word News. In London is Leanne Gerrans. Hi, Leanne.
Hi, Francine. New Zealand's Prime Minister, Jacinda Ardern, says she's stepping down in a surprise resignation ahead of a general election later this year. Ardern, who was the world's youngest female leader when she took power in 2017, says she no longer has the energy or inspiration to seek a third term. Her ruling Labour Party will hold the first round of voting for a new leader on Sunday.
I know what this job takes. And I know that I no longer have enough in the tank to do it justice. It's that simple.
Now, Microsoft and Amazon have begun cutting a total of 28,000 jobs, part of a post-pandemic reckoning for the tech industry. Microsoft has started notifying some of the 10,000 workers that will lose their jobs this quarter. The 18,000 job losses at Amazon represent about 6% of the online giant's workforce. Both companies say the cuts are needed to offset slowing sales. And English football clubs have cemented their position as the leading revenue generators here in Europe. Manchester City took the #1 spot in Deloitte's annual Money League for a second year running, with 5 more English clubs filling out the top 10. Man City's revenue, up 13% last year, was boosted by a sharp increase in commercial income. Liverpool and Manchester United also made the top 5. Global news 24 hours a day on air and on Bloomberg QuickTake, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Coming up, disruption across France as strikes begin the government's plan to overhaul the pension system. We'll have plenty more on that. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one, and through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
This week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As energy crises loom, wealth inequality intensifies, and global power dynamics dominate headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts.
Does that mean the central banks are going to keep rates higher for longer? Maybe. And that's the issue that I have related to liquidity.
Coverage continues only on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance, early edition of Francine Lacroix here in Davos. I was going to say London. We're in Davos, but day 4, it's very cold, and there's been a lot going on. Now, the Oaktree Capital Management co-chairman, Howard Marks, believes the financial markets could be in the middle of a sea change not seen in 50 years. Well, he sat down with Bloomberg's Romain Bostic for an exclusive interview, and the billionaire investor says, well, investors need to get accustomed to normal rate environments moving forward.
With the appearance of the inflation and the increasing of rates to try to stamp out the inflation, things have gotten harder. I imagine people today saying, well, when are we going back to normal, like it was 5, 6, 7 years ago? And the important thing to know is that that wasn't normal. Right. That was the easiest, the best of times. Right. And my own belief is we're not going back there. We're now in an environment of more normal circumstances, and we're going to roughly stay this way.
Well, do we go back? I mean, what do we go back to at all? Because when I sort of read that memo and I look at sea changes, it sounds like everything new is new. It's never really a reversion to where we were in the past.
Right. Well, that's what a sea change is. It's a complete transformation, not just a minor cyclical fluctuation. So, look, I think that the business world, the economic world, is not supposed to be easy. It's not supposed to be easy to make money. Right. It's not supposed to be easy for companies with bad business models to stay in business, as it has been for the last 14 years. Right. So I think we go back to a period in which we have moderate interest rates, we have moderate availability of capital, we have a moderate default rate, and so forth, all of which will feel much less accommodative, I think, than the last 14 years.
But so much of the agita in the market right now is, of course, people trying to figure out what that new rate is, right, or if you want to call it a neutral rate or whatever. But, I mean, when was the last time that you could remember that we had a stable and persistent neutral rate?
Well, it depends on your definition of stable time-wise, but of course, I think that the Fed became activist with the arrival of Alan Greenspan in the mid-90s, and I think that it's we had, people started to talk about the arrival of the Greenspan put, that if there was a problem in the economy, the Fed would just squirt in some liquidity and solve it. And
they frequently did.
And they frequently did, including Y2K and other real and imaginary crises, the arrival of the bursting of the TMT bubble, for example. So I would say that that's 25 years that we haven't had what I call a free market in money.
But what gives you conviction that Jay Powell and whoever his successor might end up being are going to sort of move in a different direction, where they're not going to necessarily kowtow to the market in a way that the market has come to expect?
I'm applying common sense. You can't always count on common sense, but you know, the events of recent years tell me that it's not great to have interest rates at zero. Zero interest rates are really an emergency measure. Somebody gets a heart attack, you give them a shot of adrenaline. Works.
Right.
That doesn't mean you start your day with a shot of adrenaline every day for 7 years.
Right.
We had rates at zero for 7 years. And I think that, you know, and by the way, by the time 16, 17, 18 rolled around, people started to say, well, shouldn't rates be a little higher so that if we have a recession, the Fed can cut rates and become accommodative? Well, if rates are zero or a quarter or a half, you can't do that. So I think that's an important reason why rates should be positive. And if you want to fight inflation and kill off inflationary psychology, which is very important, you need a positive real Fed funds rate. That is, the Fed funds rate has to exceed the rate of inflation.
And we
have a way to go.
Well, that was Howard Marks, co-chairman of Oaktree Capital Management, speaking exclusively to our Romain Bostic. Now, despite higher interest rates, parts of the American economy are still going strong, gaining much from post-pandemic spending, especially in leisure and travel. That's the view of Blackstone Chief Executive Officer Steve Schwarzman, who sat down with David Weston here at the World Economic Forum.
Well, I think in the United States, you know, we're obviously fighting higher interest rates, but we're doing it from the perspective of an economy that's in quite good shape. One of the reasons for that is an outcome of the pandemic. And during the pandemic, people stayed at home. What every country's government didn't figure out is the 90% who kept being employed would end up having way more money after the pandemic because their cost structure collapsed. They didn't go to movies, they didn't leave their homes, they didn't travel, they didn't buy expensive clothes, and that $2.5 trillion of extra money was in the banking system, and they've been spending that money. And that's been keeping the economy performing better than people expected. They've spent about half of it. Whether they spend the rest of it, whether they save it, but that's an extra stimulus, if you will, that's kept the U.S. economy moving ahead pretty well. The Fed, of course, is trying to do something with inflation, and they have to, assuming they really want to get it all the way down to 2%. So they've been very aggressive, moving, and the question is, how much effect does that have? We're starting to see the economy slow down a little, and particularly in interest-sensitive areas. One would think it would have had more impact, but it hasn't yet. And the reason we've developed almost a two-part economy. Interest-sensitive areas like housing, where new house construction is down 19%. Usually in a recession, it goes down 35%. So you can see how far we are away from the bottom. It's affected Wall Street and markets because when you raise interest rates very high from a percentage of where you started, it'll have adverse incomes. And there are other parts of the economy that frankly are still extremely strong, that raising interest rates hasn't affected yet. Stuff like travel. Airlines just can't even cope with the volumes. Resort hotels. People after the pandemic were so grateful that nothing worse happened to them, that they just want to celebrate and live life.
The Blackstone Chief Executive Officer, Stephen Schwarzman, speaking, of course, to us here in Davos at the World Economic Forum. Now, the question that we're trying to figure out today is not only the energy complex going forward, but of course, is there too much optimism here in Davos? Just 3-4 weeks ago, when we didn't know that there was less predictions that inflation was peaking, but also when we didn't know that China would reopen really by 160 degrees, there was so much more concern. So there's one man who's going to come on with me. He heads all of our Davos coverage. He's Simon Kennedy. Also coming up, the Chief Executive Officer of Germany's Merck Group, Belén Garrich Lopez, will be speaking to me here in Davos. That's a conversation on not only healthcare, but government spending. This is Bloomberg.
of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
The moment news breaks, no one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there was a lot else that happened.
1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority. A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Davos. Now, the European economy had, we all know, a challenging year in 2022, plagued by Moscow's war in Ukraine. Germany has been at the forefront of the crisis with its reliance on Russian energy. Now, speaking to us earlier, the EU Economy Commissioner, Paolo Gentiloni, says the bloc has managed the energy crisis better than expected, but Germany's economic future remains uncertain.
Technical recession, meaning 2 quarters with negative, is uncertain at the moment. I think this could be confirmed, or we could have surprising better data. It's not so different. It's a matter of point something, yes, the difference. Yeah. The point is how real is the perspective that after the first quarter we will restart growth in Europe. And in our estimate, growth will restart, but it will be very subdued.
Paolo Gentiloni, European economy, well, the EU commissioner actually for economics, not the minister, speaking to me a little bit earlier in Davos. Now, we're joined by Simon Kennedy, senior executive editor for Bloomberg Economics. I can also give you a promotion. Titles are changing, ever changing when you're in Davos and it's in the cold. So talk to me a little bit about the mood here. So it's quite optimistic, given what we've lived through, but also given what these chief executives were thinking 3 weeks ago. Are they too optimistic?
Absolutely. I think what you're seeing here is that I think they want to believe, they want to find reasons for hope, and there are some reasons for hope. You've seen it in the interviews on this stage over the last few days. You've seen a better winter, a stronger Europe. The German Chancellor talking to us earlier in the week, optimistic about swerving a recession. The China reopening, a big theme earlier this week. The feeling that that might deliver some bumpiness in the near term, but some longer term strength towards the end of the year. Geeta Gopinath of the IMF sums it up quite well yesterday, talking to you about how it's a tough year ahead, but that we're going to see gradual improvement. And so when you talk to the executives, when you talk to the bankers, this tentative, this cautious optimism, this wanting to believe comes through.
Yeah, so what are they most optimistic about? Because I keep on hearing, look, it's the reopening of China. Are they underestimating the hike in inflation or the spike in inflation that we get from that?
So it's you're looking at the same data with different lenses. So for them, the peak of inflation is past, they think. The slowing of inflation is coming. That will prompt the central banks to maybe pull back. Bloomberg reporting earlier in the week that the ECB may do that in coming months. A lot of people thinking that the Fed, in just a couple of weeks, will embrace a slower pace of rate hikes. So they're hoping slow inflation means fewer hikes from central banks. They're hoping that the China reopening leads to this splurge in demand worldwide via tourism, via manufacturing. Put that all together, you can get quite a nice outlook from that. But again, as Larry Summers said yesterday about the US debt ceiling, hope often triumphs over experience, and I think that's probably a good theme for overall Davos. Because again, there's all these risks. There's the war, there's geopolitical differences, there's the coming fight over the debt ceiling, there's inflation, there's the interest rate hikes, and you could be, if you're a central banker if you're a central banker here, of which there are many, you could come to Davos and go back to your office and go, actually, if these guys are more optimistic, we're going to have to keep hiking because inflation's not coming down. Again, a theme yesterday, Raghu Rajan, formerly of the Reserve Bank of India, saying that central banks and fiscal policy aren't aligned. That's going to take a while.
I mean, it's amazing actually to see that the participants here, and every year they're in flux and they change. So we don't have anyone from the G7 apart from Olaf Scholz, but there's a very big contingent from emerging markets. Is this their year?
Absolutely, and it's mainly it is an emerging market event to some extent now. You have to obviously see a lot from Latin America, a lot from Africa. Even the frontier markets are well represented here. And if you read John Authors on Bloomberg today, the emerging markets so far are the big winners into 2023. And again, that's another force for strength in the world economy. If you have these kind of smaller growth engines starting to power upwards, that also helps lift the world.
So very quickly, you lead all of our coverage. So it started by TV and beyond. Now we have newsletters, we have of course social media, we have like 6 or 7 cross platforms. What's most popular? What do people want to know about, from Davos?
So I think what they want to know about is what we've just talked about. Is they want to know what's the big message coming off the mountain, but they also want those interesting stories about they want those as well. But I'm not sure we're the home for those. But they also want to know about artificial intelligence. They want to know about the 4-day work week, quiet quitting, these new trends, or perhaps old trends, which are now getting into the main stage.
Simon, thank you so much. And you can, of course, follow all of that coverage. And as Simon was saying, there are very different strands to this. You can go on the terminal, the website, and we have like 4 newsletters also coming out. Now, French unions are taking part in a nationwide day of strike actions against the government's plans to revamp the pension system. Let's bring in Bloomberg's Caroline Conan outside the Gare Paris-Saint-Lazare for more. So, Caroline, what disruptions do we actually expect in France today?
Francine, it is the first day of the general strike against the pension reform announced by Emmanuel Macron last week, and it is expected to be very painful. These are the words of the transport minister. We expect some disruptions on the trains, in the air, with the planes, but also in schools, in hospitals, oil refineries, and even some nuclear sites. To give you an example, for example, I'm in front of the Gare Saint-Lazare. You have some TGV high-speed trains. There's not going to be more than 1 in 3 trains today running across the country. And for the regional trains coming from here at Saint-Lazare, only 1 in 10. So you can imagine it's going to be very difficult for the French and those who have children. Also, this is going to be a challenging day because 70% of the teachers are on strike today. This afternoon, I'm going to go and see the protests in Paris. The goal of the union is to reach at least 1 million French people in the streets today.
Well, that's something that a lot of the French people will have to live with. Here in Switzerland, I have to say the trains are not only running well, but also on time, which is surprising when you come from some continental European nations. Caroline, thank you so much. Great reporting on the ground there in front of the Saint-Lazare station in Paris, Caroline Conan. Now, coming up, the Chief Executive Officer of Germany's Merck Group, Belén Carrijo-López, will be speaking with us here in Davos. This is Bloomberg.
Humanity consumes 500 billion cups of coffee every year. That's almost double what we consumed a decade ago. And yet, coffee production is one of the most antiquated industries in all of agriculture. Climate pressures like drought, heat, and blight are affecting food producers in different ways all over the world, as climate change becomes something we can taste. In the past year, hundreds of thousands of acres of coffee plantations were wiped out. What's at stake are the livelihoods of around 125 million people. Because, if you're being honest, this is a plant that cannot hold on much longer in a changing climate.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Davos. Now, let's get to another key interview here from the World Economic Forum. Joining us now is Germany's Merck Group Chief Executive and Chair, Belén Carrijo-López. Thank you so much for joining us. I know this is, Merck, and actually for those who don't 100% know, the company has 3 main divisions, and those are very different divisions. Of course, it's life science. Of course, it's also biopharma, but electronics.
Yes.
Out of those 3 businesses, what do you think will outperform in the year or two, in the next year or two, given the changing economy?
So, first of all, thank you for inviting me. It's a pleasure to be here. Well, first of all, let me start by saying that we are a globally diversified company, and that diversification is a very, very important pillar of our resilience over the years. So the 3 businesses have been performing very nicely during 2022. We have communicated figures in Q2 in which we delivered strong growth. Our main growth driver in Q3 for both revenue and profit was life science, followed by healthcare. Electronics is influenced significantly by the downturn, by the cool down of the display market in
supply
China.
chains?
Not so much. It's basically, I mean, we are driven by semiconductors in electronics, which is a very strong, solid, which is delivering very strong, solid growth. But of course, the end market of smartphones went down and computers went down significantly after the pandemic, and this influenced negatively our display business, right? So despite the good performance of semiconductors, electronics was a bit down in Q3.
I think in your Capital Markets Day, you were saying that you are ready to do acquisitions, even sizable acquisitions, as soon as 2023. Are you still of that view? Is it because of valuations or just opportunity then for growth?
Let me once again repeat that our midterm ambition of delivering 25 billion by 2025 is secure with our organic growth. We are heavily investing in expanding capacity and in really regionalizing our footprint. And we don't need to make an acquisition to deliver on that ambition. But we have, in relation to our great operational performance, we have enhanced our financial position, and now we have a capacity of between 15 and 20 billion euros that, of course, could eventually contribute to accelerate the growth of our businesses.
And now is a good time because of cheaper valuations and some of the headwinds, or is it a risky time?
Look, valuations are still high, both in biopharma and life science in particular. So we are, you know, our M&A strategy may be taking different forms, and we are going to keep our optionality. We have already done bolt-ons to acquire new technologies, mainly in life science, but also in biopharma. And we will continue to do so regularly.
But is there a specific, you know, given your three divisions, is there a part of the business that you think would, you know, take more advantage? Is there something that you're after, that you're looking at the moment to acquire?
Our capital allocation is absolutely sharply focused on our three pillars of growth. And this is process solution, CDMO, so services, life science services, and the healthcare pipeline and semiconductors. We will continue to groom this pillar, and we have announced already significant CapEx investment every year to fuel that growth. Now, when we look at M&A, we are scanning the market permanently, right? And we value life science because life science is highly predictable and very stable, highly attractive markets. And of course, biopharma and biotech will continue to heavily invest on developing biologics and pipelines, also novel modalities, and this is our sweet spot.
I want to talk to you a little bit about the future of work, but the future of hiring. So you were on a panel and you said something has changed, right, in the way you want to hire, so that it's not about experience, but it's about attitude. When did that happen, that change, and how you look at hiring and what the type of talent you want to attract?
This has been, I mean, talent is more important than ever before. Right? I think Merck is a caring organization, people-centric, and of course, you know, in the last few years, we have become even more attractive because of our diversification and the company, the values-driven company who we are. People, you know, you implement through people. There is no good strategy. You always implement through people. So building a high-impact culture became a key dimension of our enterprise strategy. And in that context, not only voicing clear leadership expectations, but also raising the bar on talent became a priority.
But it's difficult. So attitude, is it in interviews? Like if you get, I don't know, 200 CVs for a position, what are you looking for if it's not experience? Like what makes the difference in a CV that catches Merck's attention?
Look, we are not only relying on interview to make people choices. I mean, people would ask me, what is the most difficult decision you make? And they would expect that I say capital allocation decisions, actually making people decisions.
Who you hire.
Who you hire, who you develop. Who are you focused on retaining is one of the most difficult decisions that leaders make. So there is, the importance of people have grown during the pandemic, and having a very robust people strategy in which talent is the main pillar has been my obsession. So you see, you cannot do new things with the same experiences, right? First of all, there is an emergence of new capabilities like data scientists, engineers, not the traditional pharma or life science profiles, right? So we have acknowledged this and integrate that into our strategy. And it's not interviews. Attitude and leadership is always what help people raise the bar and deliver.
Thank you so much for a great conversation. We need to talk about this a lot more because I think it's probably one of the things that chief executives worry about the most is, of course, retention of talent, but also how you pick the talent that you want to make sure you keep in the company. Germany's Merck Group Chief Executive, Belén Carrillo Lopez there. Now, JP Morgan Asset Management, Asset and Wealth Management Chief Executive Officer Mary Callahan-Erdoes says the Fed is doing its job effectively in the face of continuing price rises. While she spoke with David Weston here in Davos.
It's a funny thing when people say inflation has peaked, or it's not. Inflation is just going to grow slower. We still have, goods and services that are up 15% over the past 2 years cumulatively. And so if you only grow at 4% for the next 2 years, you're going to find yourself at things that are up 25% from where they were before we started this. So that's a lot to digest. And wages have to keep up with that. Savings have to keep up with that. We've had nice cushions, particularly in the U.S. consumer. We bank half the households in the United States of America through Chase, and we can see a lot of the actual data. There's been a nice cushion of days of cash on reserve in people's accounts, but that's depleting. And for the lower income, it looks like that might get back to pre-COVID levels of about 19 days worth of a cash excess. By the time summer comes, that's not a lot of cushion to be able to think about where that money needs to be spent. And when prices continue to increase, you need to have the system in balance. So, the Fed is doing its job. Effectively, the Fed funds rate is even higher than what it may appear to be. There's some studies that show that it may be as high as about 6.5% effective in the world. And so the whole world is priced off of fixed income. It's priced off of what is the discount rate you're going to use on future earnings. So that's the most important conversation that we're having. But thankfully, we're having it with yield back. And so, bonds have always been a very important part of the conversation, but with many of them negative yielding for the past several years, it's a much better time to think about bonds in the portfolio and a positive contributor. And so I think we're going to have a better sledding going forward.
Which takes us back to your portfolio. As you say, it's got to be balanced, and you referred to 60-40 before. When you have the discount rate really going up, it favors bonds. Does it disfavor equities? Is this a bad time, actually, to really be doubling down on equities because that discount rate is going to discount your future cash flow?
Yeah, I think most of that's fairly priced in. It's going to depend on where things go on any given day. It also depends on currencies and how you think about that. But most importantly, it depends on profitabilities of companies. So they have to go back to being profitable. You're seeing companies rein it in a little bit. Lots of announcements coming out over the past couple of days. And so on the margin, people are going to be really fine-tuning how that works. And those that continue to show profit and growth for that, they should be rewarded with high PE ratios. And those are the companies you want to invest in for the long term. And this is really about long-term investing. So that's the focus. That's what people have to keep their eye on, and that's what we spend a lot of time doing at JP Morgan.
Well, that was JP Morgan Asset and Wealth Management Chief Executive Officer Mary Callahan Erdoes speaking with David Weston. Now, coming up, we'll have plenty more from Davos. America's climate envoy says Europe should boost its green spending to match the U.S. We'll hear from John Kerry next. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
The biggest frustration right now with respect to moving rapidly in dealing with the climate crisis is the lack of available concessionary funding that can be made as a grant or that can leverage other money to be invested in order to accelerate the transition. We really need to find new ways of attracting capital to the table. One of them is with a blended finance approach where we get public money that can de-risk a deal so that the private sector can come in and not feel it is at risk to such a degree that they're not willing to make the investment. President Biden, as I know, committed to trying to effect some reforms with respect to the multilateral development bank structure. We think there's a lot more lending that could take place at lower rates that would be helpful to countries. So there are definitely things we can do. But in the end, the private sector is the one entity that has the levels of funding that need to be invested in this effort.
Well, that was U.S. climate envoy John Kerry with, of course, well, a good conversation on me. And this was on the back also of Janet Yellen and Liu He of China talking about more cooperation in terms of finance availability for ESG. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gears. Hi, Leanne.
Hi, Francine. The Total Energy CEO is urging French motorists not to panic buy fuel ahead of strikes over a government plan to overhaul pensions. Diesel and petrol deliveries are set to be paused as part of a 24-hour walkout across France today. The strikes are expected to disrupt everything from energy production to manufacturing as labor unions protest Emmanuel Macron's plan to increase the retirement age. Now, Blackstone has raised a record $22.2 billion for a fund that will acquire stakes from pensions, endowments, and also other investors. The haul, which far exceeds the firm's initial target, is the biggest secondaries fund ever raised. It comes as a private equity giant further expands beyond its buyout roots. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you. Stay with us. Many great interviews from Davos still to come, including the head of the World Trade Organization, Ngozi Okonjo-Iweala. This is Bloomberg.
A cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
destinations.
functional.
Exactly, value fractional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take
How
to do?
about the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Information you want, analysis you trust, everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
This is Bloomberg.
The days of us raising them 75 basis points at a time have surely passed. In my view, hikes of 25 basis points will be appropriate going forward.
A slower pace is just a way to ensure we make the best possible decisions. We can, and if necessary, should adjust our overall policy strategy to keep financial conditions restrictive, even as the pace slows.
With the appearance of the inflation and the increasing of rates to try to stamp out the inflation, things have gotten harder.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. It's a record start to the year for bonds. That's led to an unprecedented debt sale bonanza by governments and companies around the globe. Labour unrest across Europe strikes in France today, may bring much of the country to a standstill. In the UK, almost 500,000 workers plan to walk out on February 1st. And a shocking announcement in New Zealand. Prime Minister Jacinda Ardern is stepping down months before a general election. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, yesterday in the US, today in Asia and Europe, it seems the day that bad data in the US started to really weigh on sentiment and get people thinking about how weak things could get for the global economy rather than just inflation.
Yeah, this idea that maybe bad news is finally bad news again if it means that the growth outlook is deteriorating more rapidly as policy has tightened around the world. That is definitely something markets have continually contended with, and that definitely was true in Asia overnight, where stocks broadly were lower. The MSCI Asia Pacific Index down by about 0.5%, but really the losses were led by Japan, which is kind of a separate story. The Nikkei 225 was down about 1.5%. That reversing a large part of yesterday's gain, and that probably has a lot to do with the reversal we have seen in the Japanese yen. Remember, yesterday, the BOJ kept its policy settings unchanged, defying the expectations of traders. We saw some remarkable weakness in the yen, and then by the end of the day, it had recovered a lot of that, and it is now strengthening against the U.S. dollar today by about 4 or 0.5% at 128.32, making the yen the best performer in G10 against the dollar today. One of the worst performers against the dollar is the Kiwi, the New Zealand dollar, weakening by about 0.9% to just under 64 cents on the dollar. And of course, that is in the aftermath of that shock resignation announcement from the Prime Minister, Jacinda Ardern, which Anna mentioned, Matt. And of course, we're going to have more on that in just a couple minutes.
Yeah, I've been talking about it too. What happened over there in New Zealand? Here in the U.S., we're looking at a loss on futures of about 0.4%. We did close the cash trade down 1.5% yesterday, as Anna says, after that retail data came out. Really, I guess, highlighting concerns for investors that we could run into a recession. We had the biggest drop in retail sales in a year, and we also downgraded the prior month's retail sales. So maybe the consumer isn't holding up as well as we thought, or at least tightening its belt. You see the 10-year yield, it really slid over the last couple of days. I think about 35 basis points if you look at it, because we were up at 365 just a few sessions ago, and now we're at 335. So right now, offering not a very competitive yield to stocks. Nonetheless, the recession fears have investors in sell mode. NYMEX crude, which had been approaching Brent levels, you remember yesterday or day before I was saying this isn't Brent because we were up well over 80. Now we're back down to 78.50. Of course, those recession fears make one worry about demand in the oil space. And then Bitcoin coming back off of its highs. So we were up well over 21,000, back over the FTX prior to the FTX explosion levels. Now we've come down. Right now you see a little bit of a gain, just 0.08%, but we actually had 2 back-to-back days of losses, snapping the winning streak in Bitcoin that we've seen throughout the beginning of the year. Anna, what do you see in Europe?
Yeah, the European equity session then, Matt, dominated by that negativity around that data over in the US, really. So 3 pieces of data weighing on sentiment yesterday in the US. That's come through into the European session, or continues to do so. And we see European equity markets down 0.6%. It's quite broad-based, actually. Most sectors here in Europe are in negative territory, just the likes of healthcare and food, beverage, tobacco. Those were the ones that in the early part of today were doing a little bit better. This is one of the sectors on the back foot, down 2.5% on basic resources, the mining sector. That weighs on the London story, of course. When we're nervous about global growth, we're nervous about mining stocks, and that weighs there. Brent crude, the same story. It's the Brent crude price at 84.16, down another 1%, and that, again, is to do with concerns around global growth once again. The French two-year yield I've put in here, we're actually seeing some movement higher in this yield, some selling at the short end of the European curve. And this is really to do with the ongoing pushback we're getting from ECB officials about the idea that we step down in those hikes from 50 to 25 basis points in the European context. Yesterday, it was the Bank of France pushing back. Today, it's Klaus Knot at the ECB. So there's a lot of that kind of thinking, moving the markets around and resetting expectations for the ECB a month or two out. And this is the euro on the rise against the Norwegian krone. We heard from the central bank over in Norway, the Norges Bank, holding pat on rates, standing still on rates there, Matt. But that's not the end of the story. They do say that further rate hikes will be coming, maybe in March. That seems to be the thinking at the moment. But they're also talking about doing those hikes at a more moderate pace. And as a result, perhaps we see a little bit of movement in the currency, Matt.
All right, the euro knocky. That's pretty wonky. I like it, Anna. Let's get to New Zealand, though. A surprise announcement down under. Prime Minister Jacinda Ardern is stepping down before a general election later this year.
This summer, I had hoped to find a way to prepare not just for another year, but another term, because that is what this year requires. I have not been able to do that. And so today I'm announcing that I will not be seeking re-election, and that my term as Prime Minister will conclude no later than the 7th of February.
Bloomberg senior reporter for international affairs, Mark Champion, joins us now. So, Mark, what happened? What do we know?
Well, I think there are two things. First, I think, we should take at face value the fact that, when she said that she just didn't have it in the tank, it's a lot to get yourself together to run again for Prime Minister. And the second thing, which probably was decisive, is that, she is trailing in the polls. She's got, a real uphill battle in order to win again, and I suspect she just decided she didn't want to do it.
Well, and Mark, we have to keep in mind as well that Jacinda Ardern, while representing a relatively small country, New Zealand has, what, a handful of 1 million people. I believe the population is significantly smaller than that of just here in New York City, where Matt and I are, and yet she was a real voice on the global stage. Is whoever replaces her likely to have that same amount of influence, or was that unique to her?
That was absolutely unique. I mean, she was a really interesting character. As you say, it's a very small country, quite remote, and yet she managed to stand for the kind of liberal values that are sort of fading in a lot of other democracies. She just carried on, and in a way, she's the sort of representative for liberals and progressives in other countries who kind of wish we'd had a leader like that. At various points, there was sort of various crises that she responded to. A mass killing, where she immediately imposed gun controls. Another with the COVID crisis, where she slammed hard controls at the beginning of the crisis, seemed to do very well, but later on, the story has now become an economic one, where like the rest of the world, New Zealand has high inflation. The economy is just not doing as well, and she's fallen behind in the polls to the National Party, which has a very traditional conservative message, which is we can get the economy going again, and the Liberals cannot.
Mark, thank you very much. Our senior reporter for international affairs here at Bloomberg, Mark Champion. Yeah, maybe we take those polls at face value. Certainly somebody who managed to cut through during the pandemic on the international stage. Now, Europe on strike. Almost 500,000 workers in the UK are set to walk out on February 1st. In France today, unions aim to bring much of the country to a standstill in response to Macron's pension reforms. Bloomberg's Caroline Conan joins us now from the Saint-Lazare train station in Paris. Caroline, what disruptions do we expect to see then in France today?
Anna, the pension reform announced by Emmanuel Macron last week has angered a lot of French people. So this general strike today is expected to be very painful. This is according to the French transport minister. For example, right here from Saint-Lazare, you have some national trains, you have some regional trains. About 1 in 3 high-speed TGV national trains will run across the country, 1 in 10 regional trains. So you can imagine how difficult today this is going to be for a lot of the French. And for those who have children, even a more challenging day, because 70% of the primary school teachers are on strike today. We will also expect some disruptions in oil refineries. You've seen some French people queuing again at the petrol stations because they were worried that they would run out of fuel over the next few days. And finally, there will be some disruptions in terms of electricity production with some reduced capacity expected to be equivalent to about twice the consumption of Paris, the capital.
Okay, so it sounds pretty chaotic, Caroline. What does this mean for President Macron? Will he back down?
It will depend on how many people actually descend on the streets and protest. There's going to be protests and marches across the country today. I will go at the protest in Paris this afternoon. Unions expect to gather at least 1 million people in the streets. But of course, even if 2/3 of the French people are opposed to this pension reform and to raising the retirement age from 62 today to 64, that doesn't mean that everyone will go down and descend on the streets. So we'll have to see if it's more than 1 million, it's a victory for the unions. If it's less, it could be a victory for the government and President Macron.
Caroline, thank you very much. Bloomberg's Caroline Conan with the latest on the Labour story out of Paris. Now, the best start to any year for bond returns is helping fuel an unprecedented debt sale bonanza by governments and companies around the world. Global bond sales have hit nearly $600 billion in 2023 so far. Bloomberg's markets reporter Valerie Teitel is here to take us through where all the issuance is coming from. And Valerie, it seems you can't move for investors saying they've got appetite for bonds right now, and now it's being met by a whole wave of supply. Where's it coming from?
Yeah, you're right, Anna. Investors are just gobbling up, and it is all over the place. In Europe, it's mostly financials. In Asia, it's dollar corporate debt. That's on the tailwind of the China reopening narrative. And we're also seeing a decent supply in emerging markets. We have some impressive stats. The issuance so far, it's only been 2.5 weeks in January, equals 40% of the total issuance from 2022. It's a 250% jump on the issuance versus last January. And let me take you through some of these deals. Saudi Arabia came to market with a $10 billion deal. It's the largest EM sovereign deal in 3 years, Anna. It's a slew of emerging sovereigns behind it in the pipeline. Some of that is not surprising, given EM countries have some of the highest real yields out there. And a lot of them, look, they hiked before the Fed did. Their economies are faring fine. And if the Fed is going to be cutting rates at the end of this year, it could be a huge tailwind for EM fixed income.
Hey, Oaktree co-founder Howard Marks was on Bloomberg Television yesterday. He said he thinks financial markets may be in the middle of a third sea change. Listen to what he told Romaine Bostick.
With the appearance of the inflation and the increasing of rates to try to stamp out the inflation, things have gotten harder. I imagine people today saying, well, when are we going back to normal, like it was 5, 6, 7 years ago? And the important thing to know is that that wasn't normal.
Right.
That was the easiest, the best of times.
Right.
And my own belief is we're not going back there.
All right, so, you know, things are going to be different this time. Do you see that in evidence in the data?
Look, he raises a lot of good points, but I'd argue that junk issuers, like he was talking about, took advantage of the low yields in the past and really extended the maturity, extended their debt profile. They're sitting on quite healthy balance sheets. And secondly, it's all about supply and demand. With such little junk bond supply in 2022, as a lot of those junk issuers were kept out of the market by volatility, there is a lot of pent-up demand behind it. We're seeing that especially in the most riskiest bond ratings. Double-digit yields, they're just enough to stomach the risk-reward to some. But look, I agree, further margin pressure on an economic slowdown, that is the key downside risk, but it looks like there is demand out there and issuers are meeting it.
All right, Bloomberg's Valerie Teitel in London, thank you so much. And of course, a potential economic slowdown is a topic of conversation at the World Economic Forum in Davos. So let's go there now. Wall Street Week anchor David Weston is there with the head of the World Trade Organization. David.
Yeah, thank you so much, Kelly. As you say, trade is so important to global Wall Street. That's why Wall Street Week is here today, and we're delighted to have the Director General of the World Trade Organization. She is Ngozi Okonjo-Iweala. So, Director General, thank you so much for being here.
Thank you, David.
A lot of talk here about global growth, and that's so dependent upon trade. We've heard from the World Bank. They're taking their estimates of global growth down. Where is the WTO in terms of global growth, particularly in trade?
Well, I'm afraid our own forecasts are also on the downside. We are going from 3.5% growth of merchandise trade last year to 1% this year. So that's a considerable drop. So it's very much in line with the lower forecast for GDP global growth that we are seeing.
We're seeing China reopen, which may be helpful to the global economy. We also saw Liu He, the Vice Premier, meet with Janet Yellen, the Treasury Secretary, over in Zurich, Switzerland, earlier this week. What are the prospects, perhaps, for China coming more, if I can put it this way, back online and helping some of those trade numbers?
Well, look, there's quite a bit of optimism that is being attached to the opening up of China. And I think the meeting of Yellen and Liu He is a good sign, but I think we should also keep it in check. You know, we always swing from one extreme to the other. China, certainly, its opening up will contribute, and we will see Chinese consumers, you know, their demand will go up for goods, and hopefully the factories will open up. And with what we are seeing in terms of freight costs coming down, supply chains becoming, you know, more functional, there's some hope for things to improve. But I just want to put a caution, because there's a lot of uncertainty around that. You know, we have many uncertainties, not only within China as to the trajectory of the pandemic and what will happen, but also we still have the war in Ukraine going on. We still have the issue with food prices, energy prices. So I would put some caution around it. There are a lot of uncertainties.
What about the larger, longer track of trade? Globalization has been a subject at Davos, Switzerland, for many, many years. And I won't say we're going away from globalization, but it certainly is changing as we see perhaps not global things, but blocks form. Yeah. What is that doing? Do you see that phenomenon, and what is it doing to trade?
Well, it's important to note that trade will be central to any recovery. And even though we see the goods trade, the growth of goods trade decelerating, volumes are high, and even trade between China and the U.S. and between China and the EU, you know, they're at record highs. So let's keep all that in perspective. Trade is going to play a central role. I just want to say that one interesting phenomenon is the rise of the digital services trade. That is growing at phenomenal rates, and we've gone from about $1 trillion in 2005 in terms of value to 3.5 trillion or thereabouts now. So I say trade is central. That's why it's important to be careful what we do in terms of fragmentation. When we talk of decoupling and fragmentation, I'm realistic. I know the geopolitical tensions are there, but the costs of the world fragmenting into two trading blocks, very high. We've actually done some simulations of this at the WTO, and we've seen that if we break into two trading blocks, the global GDP is going to decrease by 5% in the longer term. Just think about that. OECD countries lost 3.5% of GDP during the financial crisis. This is more. You're talking of the economy, losing the whole economy of Japan, for instance. So this is something we need to be careful about. Now, do we need to diversify supply chains because we've seen vulnerabilities? Absolutely, but how we diversify is important.
We have the issues of globalization and trade. We also have climate, and addressing climate. And I wonder if those two may be butting up against one another. We have the Inflation Reduction Act with special subsidies inserted to try to really start the green economy in the United States. We see Europe very unhappy about that. What is your take on that? Is it healthy in some sense to have that sort of competition to get to green faster?
Look, countries trying to get to net zero by 2050 or earlier is an important thing, because climate change is real and we're living with the consequences. How they do it is what we need to look at. And of course, from the standpoint of the WTO, we see the EU and South Korea, they have some issues with the way the Inflation Reduction Act is being done. What we've said to them from the point of view of the Secretariat of the WTO is to encourage dialogue. It's far better for them to speak to the US and try to resolve this and see if there's any way to take account of their concerns than to come to the dispute settlement system of the WTO. So that's what we're encouraging them to do, and I think it's working. They are talking to each other.
So finally, I want to address a book that you've written, Women in Leadership, co-authored a book that featured in part the Prime Minister of New Zealand, Ms. Ardern, who is now announced she's stepping down. What do you make of that? What about the Prime Minister herself and the fact that she said, I just can't keep going at this level? What does that tell us?
First of all, she's a terrific leader. I saw her not so long ago in New Zealand when I was there. She's done a very good job, and I think she's made women proud. The fact that she's stepping down, it just speaks to the fact that, let me put it in a positive fashion, women know when to step down. When they think they've given their best and they're ready to go, they say so, and we shouldn't overread anything into it.
Well, now that's pretty interesting, the idea that one of the things women do better than men is know when to step down, because
Exactly.
we've seen some prominent examples, particularly in CEO suites, of men having a tough time stepping down.
Absolutely. I think women, I'm going to take a risk and say this. Women have, their egos are lower. They have many more things to get on with when they leave work. Work does not define them. So I think it's a little bit easier for them. And I hope I'm not generalizing, because obviously there are men who are the same, who can do the same thing. But I think she set a good example, don't you?
I don't know if I have an opinion, but it sounds right to me.
Yeah.
Thank you so much, Madam Director General. Really good to have you here. That's Ngozi Okonjo-Iweala. She's the Director General of the World Trade Organization. And now back to you, Anna.
David, thank you very much. Wall Street Week anchor David Weston there with the WTO Director General in Davos. Really interesting conversation about global trade at a crucial time, of course. Coming up, more from the World Economic Forum. We will hear from Guggenheim Global's CIO, Anne Walsh. That conversation coming up shortly. And the CEO of the stablecoin issuer Circle will be with us. Jeremy Allaire joins the programme a little bit later. This is Bloomberg.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and the electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
A multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. This week, Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As energy crises loom, wealth inequality intensifies, and global power dynamics dominate headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts.
Does that mean the central banks are going to keep rates higher for longer? Maybe. And that's the issue that I have related to liquidity.
Coverage continues only on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. Ukraine's President Volodymyr Zelensky is once again calling on allies like the U.S. and Germany for tanks, artillery, and longer-range missiles. Zelensky spoke on a video link to the World Economic Forum in Davos. He said the additional weapons will be used to target Russian forces occupying parts of Ukraine, not inside Russia itself. Citigroup is raising compensation for junior investment bankers by up to 15%. That comes at a time when many Wall Street firms are cutting jobs and slashing bonuses because of a drop in deal making. Citi's pay hikes will go to associates and vice presidents as well. It's a sign of banks' ongoing struggle to retain staff. The world's largest hedge fund says it is strongly bullish on short-term Chinese debt. Bridgewater Associates' all-weather fund reaped a 7.4% gain last year. Diversification across multiple asset classes helped Bridgewater expand in China's local hedge fund industry. It's now doubled assets under management. And Apple plans to take on Amazon and Google by expanding its smart home lineup. There will be new displays and a faster TV set-top box. That comes after Apple relaunched its large HomePod speaker. The new product line will start with a tablet that can control things like thermostats and lights, show video, and handle FaceTime chats. Coming up, we will head back to the World Economic Forum in Davos, Switzerland, and speak with Guggenheim Partners Global CIO, Ann Walsh, about the global economy, markets, monetary policy, and where we go from here. That's coming up next. This is Bloomberg.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth the 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. It's a record start to the year for bond returns. That's led to an unprecedented debt sale bonanza by governments and companies around the globe. Labour unrest across Europe, strikes in France today may bring much of the country to a standstill. In the UK, almost 500,000 workers plan to walk out on February 1st. And a shocking announcement in New Zealand. Prime Minister Jacinda Ardern is stepping down months before a general election. I'm Anna Edwards in London with Matt Miller and Kayleigh Lyons in New York. And Matt, US equity markets yesterday and European ones today losing ground, really, because of fears around global recession.
Yeah, absolutely. After the economic data that we got out of the U.S. yesterday, especially retail sales and the big slowdown there, you had a drop in the markets. The cash trade was off 1.5%, and now we're looking at futures that are down this morning. Right now, a little bit more than 0.5% on the S&P. The 10-year yield also sliding down to 3.35, so off just another basis point today, but yesterday the drop was pretty significant. I think about 20 basis points in one day at one point in the session. And we also have a drop in NYMEX crude, down 1% to 78.69 for West Texas Intermediate, so falling back below into the 7 handle from the 8 handles. And Bitcoin coming off again for a second day in a row, $20,758 after a 14-day winning streak. Bitcoin breaks that up streak. Kayleigh, what do you see in terms of pre-market movers this morning?
Well, there's a lot going on beneath the surface because there is earnings season. There's also some analyst action to talk about. Alcoa, the big U.S. aluminum maker, one of the companies that reported after the bell yesterday, EBITDA coming up way short of expectations. Plus, the company is saying that shipments are going to be a lot lower than previously anticipated this year because of the uncertainty around the economic outlook and a deterioration in demand. So that stock is down about 6%. Also down about 6% is Roblox, the gaming company. It was downgraded over at Morgan Stanley. The analysts there are seeing slower bookings growth, also little upside from ads in the near term, so that is weighing on the stock. It's a positive analyst move, though, for CureVac, of course, the vaccine maker. UBS upgrading this stock, saying its announcement earlier this month about its messenger RNA vaccine for the flu and COVID-19 was a significant de-risking event, so that stock is up nearly 10% before the bell. And finally, I just wanted to check on Netflix because this will be reporting results after the bell today. This is a stock that has nearly doubled since its low in 2022, Anna, so the bar is going to be probably pretty high in terms of subscribers and the outlook for that ad business ahead of those results. That stock is down about 0.25% before the bell.
Okay. Certainly one to watch then, Kayleigh. Here in Europe, we have a negative picture for European stocks, and things seem to be worsening a little bit as we go through the session, down by 1.1% now on European stocks. One of the main losing sectors is the basic resources sector, so mining stocks down by 2.5%. And actually, it is, though, quite broad-based, so most sectors in Europe are in negative territory. The big global conversation has been about buying bonds and some of those yields coming down, as we've talked about recently. Here in Europe, though, at the short end, we're seeing yields go higher, and this has to do with the ECB expectations in the very short term. Over the weekend, or just into the weekend, we had that story here at Bloomberg about whether we might see a step down from 50 to 25 basis points in terms of hikes from the ECB. That got some pushback from the Banque de France, and today it got pushback from Klaus Knott at the ECB. So a number of ECB voices pushing back against that idea of a step down, so giving us some more hawkishness. And here's my wonky currency pair for the morning, the euro-NOK cross. We've got the euro up by 0.6% against the Norwegian currency. The Norges Bank holding pat on rates, so no move on interest rates. That was widely expected. They are saying, though, that there could be more hikes to come, and March would be probably where they would do that if we do see some further hikes coming, Matt.
All right, Anna, thanks very much for that. Now let's get back to Wall Street Week anchor David Weston. He is sitting down with Guggenheim's global CIO, Ann Walsh. David?
Thanks so much, Matt. Yeah, Wall Street Week is coming because Global Wall Street's here, and that certainly includes Guggenheim. So, Ann, really great to have you with us, the CIO. So, Ann, first of all, talk about the possible downturn, globally or in the United States. A lot of talk about that in Davos. How do you see it, and what likely effect could that have on credit?
Thanks, David, very much for having me. So where we are in the cycle right now is we see a recession coming in the middle of this year. Now, we've actually heard a lot of optimism here in Davos, but at the same time, we know certainly in the U.S., the Fed's been continuing their quantitative tightening. They have continued their rate hikes. We anticipate, and the market's pricing in, another 2 rate hikes here in the first half of the year, along with the reduction of the balance sheet, which is not getting a lot of attention. You know, you've asked about credit. As we go through a recessionary cycle, what we can anticipate happening is that revenues will decline, margins and profits will decline. And as a result, credit will get a little bit choppier. We've seen a nice rally so far year to date. It's been refreshing change since 2022. But as we go through this cycle, we could anticipate spreads widening and there becoming more credit risk. In particular, one of the areas that we're a bit concerned about would be the lowest rated credits. And that would be both in high yield as well as in bank loans. So I think that's going to be an area for us to watch.
What are you seeing there particularly? We hear about so-called zombie companies who don't have enough cash flow to really service the debt, and they get squeezed pretty hard. And if they've been borrowing at essentially 0% interest rates, that's okay. If they have to roll over that credit at higher interest rates, are you seeing pressure on some of those companies yet?
Not yet, but we have to realize that we are seeing an incredibly large paradigm shift in the markets. We've gone from a QE world to a QT world. And that QT world is going to continue until the Fed's able to actually conquer inflation. Those companies that had ready access to capital and credit are not going to have that same access going forward. In fact, as capital gets rationed, those companies are going to suffer. So while we're coming into this cycle, and I think there's a room for some remaining optimism, and as we've seen here in Davos, but what's going to happen is that those companies that have had a tailwind in credit, up in credit ratings, access to capital, great earnings, even the zombie companies have had a nice tailwind. That's going to shift. And as we go through a recessionary timeline, we start to see that happen.
What about private credit? We had, I believe, an enormous growth in private credit, particularly with some of the regulations that were put in after the great financial crisis. What is the effect of the downturn that you anticipate potentially on private credit?
So private credit is a very large label for privately issued in the debt markets. And like any other market, there are participants who know exactly what they're doing and underwrite credit properly, and there are going to be participants that, because of quantitative easing and because of ready access to capital, have made poor decisions. And just like zombie companies that have attracted capital, we're going to see the same problem. The challenge with private credit, though, is it's private, and the transparency just isn't there for the markets yet.
Well, that was going to be my question. Will we know they're having trouble, and will we know in time? Because we won't have the same information, as I understand it, as we would from some of the public sources.
Well, that's true. And we have something we tend to call crisis at maturity, which is you don't know until you get to the very end. And I think that's going to be a challenge for the credit markets.
So break it down, if you could, between investment grade and high yield and leveraged loans. Given what you anticipate, where do you want to go? Where do you want to stay away from overall?
So at this point in time, we are repositioning our portfolios to move up in credit quality. As we go through a recession and spreads widen, they're going to widen less in investment grade credit. These tailwinds that I spoke of are really going to be a benefit for investment grade credit in particular. We avoid and are avoiding the lowest rated, CCC rated, or some of those, what I call dicier credit or unitranche credit transactions that combine senior and subordinated credit together. And those are the areas where I think there's going to be hidden risks. They're also more correlated to the equities markets. And as we go through a recession, we would see equity markets decline as well. And so that's why we're repositioning into investment grade credit. The one thing that's helping us, of course, as we've come through this rate hike cycle and quantitative tightening, is the Fed's put the income back in fixed income. So that trade makes sense now.
Exactly. Make some money on that debt. And you're the chief investment officer for Guggenheim. And you succeed something of a legend in the business and a mainstay at Davos, I must say. Somebody we welcomed on Bloomberg regularly, and that's Scott Minerd, of course. Reflect a little bit about Scott, what he left behind, what he did, how he changed Guggenheim, and even Wall Street more broadly?
So thank you for asking about Scott. It was quite a shock to learn of his passing. Scott and I worked together and were friends for over 20 years. And the industry's lost a tremendous visionary, and I've lost a dear friend. But there are several legacies that he left. The most important to me, of course, is the investment process that he helped craft and develop at Guggenheim. And it's a team-based approach based on behavioral finance. We have a deep bench of investment professionals. We have about 1,000 employees and nearly $300 billion of assets under management. You know, I've been at the firm for almost 16 years, and together we've built that investment process. I've stewarded and shepherded the investment process and the team members along with Scott for all these years. That's going to be an incredible legacy that we're going to continue, and we're going to continue to deliver the client excellence and service that our clients have come to expect, and we'll remember Scott forever.
Well, Scott obviously left a very large footprint behind him on Wall Street, on Bloomberg, certainly on Guggenheim. He also had a real presence at Davos. He had interests that went beyond what we would think of typically as Wall Street interests, global interests that are taken up at Davos. Talk about what he did at Davos and what is left behind of what he worked on here.
Well, he had a personal as well as Guggenheim has a continuing ongoing commitment to sustainability. He believed in it, we believe in it, and we think the future is one where we have to do all collectively to create value and preserve all of the aspects of nature. And he was particularly interested in the Arctic and the preservation of the Arctic, as well as understanding how climate affected the Arctic. So we ourselves, through our infrastructure team, have continued that work, and will continue the work that Scott started.
Well, we'll miss him none more than you, I'm sure. Ann, thank you so much. This is Ann Walsh. She's the Chief Investment Officer of Guggenheim. And back to you now, Matt, or Anna.
Thanks very much, David. Wall Street Week anchor David Weston there with Ann Walsh in Davos, thinking about the investment strategy, but also reflecting on Scott Minerd. Now, coming up on the program, more from Davos with the CEO of stablecoin issuer Circle. Lots to talk about when it comes to the crypto space. Jeremy Allaire joins us next. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I would separate
crypto from digital assets broadly. And I think there's still a bright future for tokenization. There's a lot of central banks thinking about central bank digital currencies. So I think that's proceeding forward at pace. And I think in terms of crypto is a broad-based investment asset, I think we're going to have I think it'll be a while before we see that.
The CEO of State Street, Ronald O'Hanley, talking crypto in Davos. We'll continue that conversation right now with Bloomberg's Lisa Abramowitz. She is sitting down with the CEO of stablecoin issuer Circle, Jeremy Allaire. Lisa?
Thank you so much, Matt. Yeah, it's really a fascinating conversation at a time where people are talking about a crypto winter around the world, and yet here at Davos, there's a lot of optimism around the potential for crypto assets, for the whole blockchain technology. We are here with Jeremy Allaire, the CEO and co-founder of Circle Financial, and I want to start there. I mean, at a time when you have bankruptcies, when you have allegations of fraud, are you surprised by the presence of crypto and the optimism of it here?
I'm not really surprised. I think a lot of people have asked me sort of why is there that kind of confluence here, and I think part of it is that, you know, blockchain technology and cryptographic money and all of these digital assets, they sort of sit at the intersection of new constructs in economic activity. And the World Economic Forum is a kind of natural place where people interested in that can convene. And so bringing people here on that basis makes sense. But in terms of the optimism, I mean, look, I've been through multiple major tech boom and bust cycles, and I'm a technologist by background. And when I look at what's happening, when I look at the past 12 months of technical innovation, I look at the current environment of technical innovation in this space, it's more robust than ever. There's tremendous progress being made in so many places. And, you know, the technology didn't commit fraud. You know, the technology didn't commit poor risk management or leverage decisions. Firms and people did that. And so I think the optimism is grounded in the fact that we're really progressing these platforms, and we're seeing the mainstream utility phase of this really starting to come upon us.
So understood that perhaps it wasn't the philosophy or the concepts or the software behind this that caused some of the damage, but you are seeing the fallout continue. And we got word this week that Genesis is potentially filing for bankruptcy this week. We're seeing the fallout from FTX continue. How many more bad actors need to get weeded out? What percentage of the overall industry need to kind of see that wash out before you can start to see real growth?
Yeah, you know, I think you know, there's sort of the natural busts that will happen because they're, you know, projects or companies that just don't have access to capital. So sort of like after the dot-com bust, there'll be some of that. But I also think there are still actors in the space that have been reckless, that have done a lot of the legal things, that operate kind of offshore. And I think until there's normalized kind of regulatory treatment and the world understands how this functions in a regulated way, that ultimately makes those kind of actors disappear. That's a challenge. Now, that will take a longer period of time. At the same time, though, we're definitely seeing emerge those companies who have been built well, who've been built to a higher set of standards with regulation, with a very different kind of fundamental philosophy. And I think those are going to be the companies that thrive.
Well, do you feel like, though, even here, there are some companies that may not survive, right? I mean, that there basically is still a strong presence of those that don't have as solid models and might not be having the same kind of accounting practices as you would adhere to? Yeah,
I mean, clearly, I don't want to like call out specific companies or anything like that.
You could. I mean, no one's listening. Go ahead.
No, but I mean, I think clearly in any kind of cycle like this, there are going to be, you know, whether they be technology projects or financial intermediaries or others that continue to have challenges or weakness, and that may 24 months from now not really be here. But again, like I think the companies that are run to a higher standard of public accountability, transparency, trust, risk management, you know, kind of operating, out in the light, so to speak, will be much stronger.
You talk about regulators and the role there. I know that you've spoken to a lot of people who are thinking about it. It's certainly on the minds of everyone from central bankers to politicians who are here at this event. What have the tenor of those conversations have been? Do you have the sense that they will really do something material that could create the infrastructure for a more viable market?
I think so, and there's kind of like two big buckets, right? I think the lowest hanging fruit that everyone has talked about actually now for years is stablecoins, which is the business that I'm in. And And there actually is stablecoin regulation going into effect in the EU, in Singapore, in Japan, in the UK under the new financial markets legislation, and very likely in the United States. And that's really critical because it's kind of the base layer of digital fiat, digital dollars, and having that be regulated under the same regulatory bodies as banks and payment systems will actually make this something that households and firms and other financial institutions will feel like they can depend on. There's the market side of this, which is the trading and markets, and that part I think is a little more complex. But I think from the conversations I'm having, whether it be participants in the Financial Stability Board or individual governments, there is a sense of we have to now be more proactive about coming up with regulation here, because the risks actually are too high, because this will continue to grow. And so if it is becoming part of society, it needs to have same risk, same rules type of approach.
And the stablecoin model is not based on nothing. It is based on having the reserves and keeping it tethered to the dollar or some major currency, and then holding those reserves in very liquid instruments. Right now, you're making a lot of interest on that as you see the rate hikes. I know that you've talked about going public before. You've postponed some of those plans. Have you brought them back to the table? I mean, is that imminent in terms of taking an IPO public?
Well, so I think what we've said is we're committed to building a publicly traded company. We think it's important to have the transparency and the trust that comes along with that. If we're going to, build partnerships with leading financial institutions and corporations, that's an important thing for us. We're in a very good financial position. We're profitable for all of last year. We're in a high growth environment as a company right now. We grew 300% last year, we're kind of taking stock and really trying to look at where the markets are, and certainly we'll pay very close attention to where the markets are.
Just before we finish, I'm curious, the relationship between Bitcoin and stablecoins. Do you think that as stablecoins get more established, there will still be a role for Bitcoin?
Well, my view is like the total addressable market for something like digital dollars is kind of, the total addressable market for cash or even M2 electronic money, so commercial bank money. So that's a $100 trillion addressable market. And I think that market is grounded in people who store value, who have working capital needs, who are making payments. That's a very big market. There's also a market for people who want to hedge against various, geopolitical things, or who want a non-governmental form of store of value. And, we have proxies for that in certain asset classes. And I think that will continue to be a big market opportunity, but it's really aimed at and solving a very, very different thing. So in the long run, I believe that dollar digital currency, euro digital currency, reserve currencies that are operated this way will be a far, far larger market than something like Bitcoin.
Jeremy Allaire, thank you so much for being with us of Circle Financial. Back to you, Kaylee.
All right, Bloomberg's Lisa Abramowitz in Davos with Jeremy Allaire, the CEO of Circle. Thank you so much. And Matt, so interesting to listen to that conversation there about the relationship between Bitcoin and stablecoins, but also this idea of can stablecoins coexist ultimately if we do see broader central bank digital currencies, and what kind of regulation do you actually need to see take shape here in the U.S. to make that happen? Because we've talked a lot about it, yet Congress still hasn't moved on the stablecoin issue in a material way.
Yeah, absolutely. And that's what we expect them to do first before they tackle any other regulation. I also think it's interesting, though, to hear Jeremy talk about the need to separate, a basic fraud or some crimes committed by individuals or companies from the technology and the underlying, currencies or commodities involved in that those companies are involved in. So, by the way, you can catch our program, Bloomberg Crypto, every Tuesday at 1 p.m. New York time, 6 p.m. London. Definitely tune in. Me and Kaylee walk you through everything having to do with the digital currency world.
Essential crypto viewing. Now, after the closing bell today, Netflix will report fourth quarter results. The company's new subscriber count and initiatives to increase revenue will be in focus. For more on what we can expect from Netflix and other big tech companies, Alex Webb at Bloomberg Quick Take joins us now. Alex, good to see you. So, as always, the focus on subscriber count here at Netflix. Is that once again the story?
Yes, absolutely, but also focus on how much of that subscriber count is going to be coming from the new ad-supported tier. They introduced this
this new tier, which was, on the cheaper end.
You pay less but get ads.
You pay less but get ads. Now, it potentially is a huge opportunity for them because it could reduce the churn, the number of people who are just ditching Netflix because they think it's too expensive. But if they get that ad business right, it could end up generating more revenue per subscriber than even the premium tier. If they're able to generate something like $7 a month in advertising revenue, which is something that Hulu is able to do, its competitor, then actually that brings them to $15 or so or more in average revenue per user. So it's potentially quite promising. It's still early days.
Yeah.
Any color on what they've been able to deliver so far will be, listened to very keenly.
So, Alex, obviously that's a kind of top-line factor, but when we think about the other side, the spending side of the business, we have seen big tech company after big tech company, Amazon, Microsoft, for example, cutting jobs, trying to cut costs in the face of a different economic environment. Where can Netflix realistically cut costs when they've been spending so much on content, and content is king?
Yeah, it's the real challenge that Netflix has, that in order to attract new subscribers and equally retain the ones you have, you've got to be bringing out big-ticket new shows on a fairly regular cadence. That is something where it seems like they've slightly found their groove in doing that. Some of the CapEx that has been splashed out in the past few years may not be quite as necessary because they have built and set up studios in places like Madrid, outside London and elsewhere. So perhaps some of that CapEx drops off, but still the greatest expense is making the shows themselves. Any color on what their plans are in that space, whether they think that perhaps there is space to kind of tamp back on that, analysts will be paying great attention to, but they do sort of constantly need to be chasing their own tail.
What did we get from the Glass Onion screening in cinemas first? Was that just a gimmick, or is that part of a model that Netflix wants to develop going forward?
Well, it's to do with the way that you attract and retain talent, because if you want to get a top director making films for Netflix, they want to be eligible for the big awards, Golden Globes, Oscars, all that sort of thing. In order to be eligible for those prizes, you have to have a cinematic release of some sort. So if you can give them even a limited release, it means it gets in front of more eyeballs, it gives them the chance of winning these awards. That also gives some oxygen to Netflix itself. And HBO has this view that actually having a cinematic release and then putting it on the streaming platform makes the platform more attractive because it seems more premium.
Okay, yeah, certainly gets people talking. Alex, thanks very much. Bloomberg Quick Takes Alex Webb with the latest on what to expect from Netflix. Just want to quickly talk about what we're hearing from Christine Lagarde. She's speaking in Davos. She's saying she is determined to bring inflation to 2% in a timely manner. This at the ECB, of course. And this in the context of some fairly hawkish commentary earlier from the Bank de France governor and Klaus Knott at the ECB. So that seems to be continuing to be the focus, that inflation, bringing that inflation down. We see stocks falling a little this morning here in Europe, partly as a result of this, and short-end yields on the rise also. Morgan Stanley CEO James Gorman joins the team in Davos shortly. This is Bloomberg.
You've been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning, and therefore the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return. And to get a long-term return, putting it into private hands is one way of doing it. But really, the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is US public sector owned, that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
There still are concerns about COVID, there still are concerns about geopolitics, and there still are concerns about whether the long-term growth prospects remain.
We're still optimistic that the disinflation story takes hold and goods prices don't have to rebound sharply.
The U.S. consumer has begun quite a considerable divestment phase.
The impact of a year of very aggressive central bank tightening and quantitative tightening are starting to bite the economy, and they're biting hard.
We just expect that the Fed's hiking for longer.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
What a brilliant week of conversation. Bob Michael at JP Morgan, just absolutely tremendous yesterday, Tom. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Farrow. Equity futures down by about 0.5%. Two big takeaways in the last 24 hours, Tom. Number one, bad news is just bad news. And two, bonds did what bonds are meant to do. Did you see that rally yesterday?
Yes, it is whiplash, whipsaw, whatever you want to call it. My head is spinning over this shift from whatever you're talking about. Is it good news or bad news? We're making jokes about it, but it's hugely tangible after the data yesterday.
Our next guest in just a moment will tell us the mood has been following the price action. Here's the mood right now this morning, following the biggest one-day decline of the year so far on the S&P. This from Julian Emanuel of Evercore, Tom. The market's New Year rally has concluded. He went on to say, and while economic surprises have increasingly occurred to the downside, the deterioration is unfolding against the backdrop of the fact that no bear market has ever bottomed before the start of a recession. The latest from Evercore this morning.
We hope you stay with us this morning on television and radio, because John and I are going to do this, and we're going to do this off the fixed income market, which is if you're in stocks, that's what you observe. And John, I'm sorry, the 2-year yield today is a textbook case of, boy, if you're in equities, watch the 2-year.
Two's very close to breaking 4%, 4.06% right now. The whole curve has dropped in the last couple of days, Tom. So the 10-year peaked intraday last year in October at about 433, 434. We're about 100 basis points south of that right now on a 10-year. That has been a big move lower in the last couple of months.
We're a family channel, so we don't do technical analysis, but it is a textbook lower yield chart. The 2-year yield from early November, right near the election, has moved from 4.72% down to, call it, 4.07%. And this is how you make money in bonds. We never talk about this in financial media, John, is the price change. And the answer is, if you bought the 2-year yield in early November, you've made a 5% capital gain plus your coupon along the way. That's how money's minted in fixed income.
Big move. If you want the day ahead, jobless claims coming up at 8:30 Eastern Time. And look out for some Fed speakers. We hear from Vice Chair Brainerd today and Williams of New York. So two core Fed speakers down in D.C.
I 100% agree with you that we have a cumulative speech from the vice chairman. She is leaned on Wesleyan economics and truly an interesting and distinctive monetary theorist. And Williams owns the high ground on our start. And that's a big debate now, is trying to game this inflation unemployment metric with where output is. And that's John Williams front and center. Bill Dudley, I believe, is scheduled to be with us as well.
Looking forward to that a little bit later this morning. Good morning to you all. If you are just tuning in, equity futures breaking down just a little bit. We're down 0.6% on the S&P 500. Yesterday, the biggest one-day drop on the S&P since the December 15th Fed meeting, I think, the middle of December, or shortly thereafterwards. So equity futures just a little lighter, softer, negative. Yields come in just a little bit, 336.78. Big rally in yesterday's session. Twos all the way out to 30s. In the FX market, euro dollar 108.29, positive a third of 1%. Some hawkish ECB speak this morning. Christine Lagarde, inflation is way too high. That's the ECB president. Klaas Knot of the Netherlands, Tom. We're only focused on the risk of doing too little right now. We've discussed that a million times. What's the biggest risk, doing too little or doing too much? They're telling you it's the former and not the latter.
I spent quality time with Mr. Knot of the Netherlands. I believe it was at the IMF meeting. This is a name that Americans don't know, and it's a name to become familiar with. I was most impressed by the rigor of his economics.
The Hawks make a continued push. We can catch up with Greg Battle now, the US head of equity and derivative strategy over at BNP Paribas. Greg Battle, we've got to lead with this. 3,400 on the S&P. Year-end is your price target. You're not looking for that dip and rip. You're just looking for a dip. Year-end on the S&P. You are the most bearish strategist on the street right now that we track. So, Greg, let's start there. Talk to me about the journey to 3,400.
Yeah, good morning. Well, I think the target itself is less of an outlier than it seems, because when you look through the forecast that many strategists have for the first half of this year, similar to us, people are looking for recessionary price action and for the equity market to make new lows. Where our view is a little bit differentiated is we're not looking for the type of V-shaped recovery that we saw back in 2020. We think there's going to be a harder environment to see fiscal and monetary response, and we think that leads us to an equity market that can have some healthy declines this year.
The BNP Paribas hallmark here is to undershoot GDP. You've always been right about that. You've never gone with the boom crew, if you will, Greg, and that all devolves down to the x-axis, the timeline. Give us the timeline of this equity weakness. Is it 1/4? Is it quarters? Or really, can you get out into the depths of 2024?
Well, I mean, obviously, we've seen some pretty big declines in the last calendar year. That was far more of a story of multiple compression than it was recessionary price action.
Right.
What we're looking for in the first half this year is recessionary price action. We think that can start with this current earnings season. We've seen some bad economic data this week. We've seen Alcoa after the bell yesterday, which was a little bit of a troubling release. And we think this earnings season over the next couple of weeks could be a challenge. But really, when we fast forward 3 months to Q1 earnings season, we think that could be really the point at which the economic data is really decelerating, and we could see some real capitulation in terms of earnings forecasts. So the next 2 earnings season, we think, could be the most troubling for equities.
What is this placement of bets right now? When you look at the cross moments around the equity market, and particularly skew, when you look at the fancy derivative chat, what does it say about the bet that's being placed right now?
Well, I think what we see in the equity vol market is a little bit of a reflection of what we've seen more broadly in the equity market, which is a more constructive start to the year. We saw the VIX trade down to an 18 handle, which is kind of very low relative to where it's been over the last year. And that's really reflective of this kind of China reopening, warmer winter in Europe, starting to translate into some short covering into the US, which people are starting to weave into a narrative of maybe this elusive soft landing is coming. But we think that's pretty inconsistent with the data. I mean, when we look at the data this week, retail sales, industrial production, empire manufacturing, this is data that's decelerating aggressively. So we think there's some signs of complacency, and I think the VIX sub 20 has been a pretty bad signal for the equity market over the past.
So there is a bit of pushback against this view. It comes from Neil Dutta of Renaissance Macro. We caught up with him a little bit earlier this week. Just listen to what he had to say, Greg. The manufacturing data, undeniably weak. You mentioned the IP data yesterday, but why does this continue, he asks. Aircraft and autos have a lot of momentum. The dollar's sold off, supporting the exports of manufactured goods, and global growth has rebounded. Neil is pushing this idea that we could have a more resilient economy than some people expect, Greg. What would you say to that?
I think we've had an incredibly aggressive tightening cycle from the Fed, and we know these things act with these kind of long and variable lags, as they say, and I think we're going to just bite some of the pain this year. So Carl Riccadonna, our economics team, point to the idea of nominal GDP falling below Fed funds as something that historically has really been a signal for deceleration in terms of economic momentum. They expect that to happen at the start of the second quarter, just when Q1 earnings are being delivered. When we look at things from a more bottom-up perspective, there's undoubtedly been a real deceleration in terms of earnings forecast momentum. We've seen it sequentially, that each earnings season has seen downgrades a little larger than the last. We think we're going to get bigger downgrades as we move through the next couple of weeks this earnings season, and we think we get bigger downgrades than that as we move through Q1 earnings. So I think the outlook is challenging.
Greg, how important is history here as well? We mentioned Julian Emmanuel of Evercore a little bit earlier this morning when he said this line here: no bear market has ever bottomed before the start of a recession. Does that weigh on you too?
Yeah, absolutely. I think that's a great stat. We produced a piece where we went back and looked at every recession and bear market over the last 100 years, and that was indeed one of the takeaways that we've seen. When we look at recessionary bear markets, and we do think we have a recession this year, they tend to be deep and they tend to be very long. We've gone back and studied all of these crashes. We see some notable similarities between where we are today and where we were in the early 2000s. That was a bull market that was driven very much by multiple compression, retail participation, tech and growth stocks led. Very similar to the bull market we experienced prior to last year. And that unwind was long, it was deep, and we see a lot of similarities of that to where we are today.
Greg, your shop has an absolutely original heritage in China, folks. This goes back well into the 19th century. BNP Paribas and China, can their boom, can their predicted boom, can their end of COVID, can their new 5 or 6% GDP growth, can that overcome the equity gloom?
Well, I think we've obviously seen the power of the reopening trade in the U.S., and that's certainly been the driver this year of this more constructive start for equity markets globally. I think that we would question a little bit about whether that's going to be sufficient alone to offset some of the headwinds that we see here domestically in the U.S., but it certainly raises the question of relative performance globally in equities. And this is one of the reasons why I'm more comfortable with this bearish view for U.S. equities, in that in the case that we're wrong on the global macroeconomic outlook and global growth is stronger, we think there are regions other than the U.S. that are likely to lead that charge higher.
3,400 on the S&P 500 year end is the call. Greg Battle of BNP Paribas. Greg, thank you, sir. Thank you very much. Reminds me of that quote from Mike Wilson of Morgan Stanley this week, Tom. Bear markets are a hall of mirrors designed to confuse investors and take their money. Is that the last couple of weeks?
Yeah, I'm not going to have an opinion on this, and I'm in triple leveraged all cash, so I don't have to have an opinion. But what I would go to is Ben Laidler's observation of multiple bear market rallies, and you become used to that: up, pull back, until you don't. And the question is, what are the set of circumstances where all of a sudden it becomes a bull market? And John, I would suggest there's not that many people calling for a quote-unquote bull market. Some people are away from the gloom that we just heard from Mr. Battle.
I think the tug of war continues, and I don't think that tug of war has changed. And that tug of war, if I could frame it as follows, looks like this. Those on the one side who believe we're about to pay the price for a year's worth of monetary policy tightening, and those on the other side who are pricing in a recovery off the back of China reopening. That's kind of been the story of the year so far. And I think the problem a lot of people have sitting at home is they're like, what's changed? What's changed in the last couple of weeks, apart from the fact that we had a rally and people want other people to get on board with that rally? And what's changed in the last 24 hours, apart from the fact that we had a sell-off? And I think the range has changed too much, Tom, looking at, say, the S&P 500.
And the confusion on the data of hard data versus soft data. We'll talk about this through the morning as well, and it is an important data Thursday.
Well, I'll tell you something that has changed, and that's just that breakdown in bond yields, and that just continues.
Yeah, that's front and center.
Yeah, without a doubt. Without a doubt. 2-year yields just north of 4%. Your 10-year at the moment, unchanged on the session, 337. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A surprise announcement in New Zealand. Prime Minister Jacinda Ardern is stepping down before a general election later this year. She says she doesn't have the energy or inspiration to seek re-election in October. Ardern is 42. She became the world's youngest female leader when she led the Labour Party to power in 2017. Strikes coordinated by French unions look to bring much of the country to a standstill today. It's a protest against government plans to revamp the pension system and a test of President Emmanuel Macron's ability to resist street pressure. Workers in railways, schools, hospitals, and air traffic control are among those taking part. Ukraine's President Volodymyr Zelensky is once again calling on allies like the U.S. and Germany for tanks, artillery, and longer-range missiles. Zelensky spoke on a video link to the World Economic Forum in Davos. He said the additional weapons will be used to target Russian forces occupying parts of Ukraine and not inside Russia itself. Two Federal Reserve policymakers favor a downshift to quarter-point interest rate hikes. Dallas Fed President Lori Logan and Philadelphia Fed Chief Patrick Harker laid out the case for smaller rate increases. Now, that came after data showed inflation at the wholesale level declined. Bloomberg's learned that crypto's Genesis Global Capital may file for bankruptcy as early as this week. The cryptocurrency lending unit of Digital Currency Group has been in talks with various creditor groups amid a liquidity crunch. It's warned that it may need to file for bankruptcy if it fails to raise the cash. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Friday, Bloomberg's Michael McKee speaks exclusively with outgoing Kansas City Fed President Esther George. What has she learned? Where does the Fed go from here? An exclusive interview with Kansas City Fed President Esther George. Friday morning at 10. Only on Bloomberg TV and radio.
Following the biggest one-day drop on the S&P 500 of the year so far, going back to the middle of December, we add to those losses this morning. Equity futures down by about 0.5%. We're down 0.6% on the S&P 500. The bond market, all attention on jobless claims, 8:30 Eastern time. Then we get some Fed speak a little bit later. Vice Chair Brainerd, New York Fed President, Mr. Williams coming up as well, so look out for that. Just look at this, though, 336.96 on a US 10-year. We are down almost 100 basis points from the intraday highs of October, Tom. And I said it earlier, bad news is bad news. That drove the equity market lower yesterday. And bonds did what they're supposed to do. They rallied in the face of that.
Yeah, there's been a shift here. Ben Emmons mentions it this morning, talking about the shift from the 9 days of exuberance to where we are now. But, John, can we agree at 407 on the 2-year short-term paper, and maybe what the Fed cares more about, that a 3.99 print is a big deal for this week?
Oh, three-handle, without a doubt, Tom, because this Federal Reserve at the moment is, yes, having this conversation about 25 or 50, but ultimately still pushing towards 5, a 5 handle on Fed funds. And Tom telling us that when they get there, they want to stay there for a while. I think it was Neil Kashkari who said that's the second phase. That's the next phase of what we're trying to achieve here. It's not just get to 5 and then start cutting. It's get to 5 and then wait there and be absolutely certain that this inflationary story is over.
Well, we'll have to see. I think we'll see. And again, I'm completely data dependent on this. And as John mentioned, for those keeping score, the hard data yesterday was sporting and led to the decline we've seen. And again, we see a Dow futures negative 200 right now. I think that adds up to, John, negative 600. I think we are negative 700 here just over the last couple of days. For those that follow the Dow Jones Industrial. Do you know that 82%? Do you know that 82% of Davos attendees follow the Dow Jones?
They follow the Dow. Are you saying
they're all fossils.
Are you saying it's an elitist index?
No, it's an ancient. The average age in Happy Valley is like 74, and they all follow the Dow.
I think we both agree on the Dow.
Yeah.
There's no separation.
Bono shows up and the needle skews the other way. Joining us now in Washington, she's listened to all of you too. Anne-Marie Horton joins us, our Bloomberg Washington correspondent. Anne-Marie, I want to go to something 3 days ago, and this is your immense skill, which is you go to a story and 3 days later you're ready in on this. Brief us now on a bipartisan Congress that hates China, and yet Secretary Yellen is in the process of a U.S.-China thaw. 3 days on from that shock, how can you interpret that?
Well, I think even if you have lawmakers that want to throw stones and create legislation or committees that are going to look into and combat China in terms of whether it's trade, human rights, or Taiwan, the U.S. is still going to have a relationship. These are the two biggest economies in the world. We also should really caveat Secretary Yellen's sit down with Liu Hu, the Chinese vice premier, because he is on his way out. As Doug Redeker put it to me yesterday, he's really a lame duck. But what this does do is it just opens a pathway for communication. And really what is key to her sit down in Zurich is the fact that it came before her tour of Africa, and she's going to go to these countries that really have big issues when it comes to debt that China owns. And this is something the U.S. is focused on, debt sustainability of these countries and all the inroads China has made in these countries with Belt and Road. So I wouldn't read too much into their sit down as it being a huge thawing of relations, but they're talking again. Remember how dire the situation was between these two countries in terms of diplomacy after Speaker Pelosi went to Taiwan. I mean, we had a missile end up in Japan's economic exclusion zone. Okay, so now you have the Secretary of Treasury speaking to her counterpart. By the way, we need to mention he's on his way out. Then we have Secretary Blinken headed to Beijing as well. The policies have not changed. Nothing has changed, but they're talking.
They're talking, and they have to move forward to some form of bilateral or multilateral approach. Are we on the edge of multilateral in America? I don't sense that with the animosity of Congress towards getting anything done.
Well, no. I mean, when China, maybe you can see something get done. We did see Congress ban TikTok on all government-used phones, right? That is a step.
Wait. We need to be clear here. Anne-Marie, we need to be clear here for the adoring horde of Bloomberg surveillance. Is Anne-Marie Horton still on TikTok?
I am not on, still, no, I never was. I never was on TikTok, didn't get into the fad, and then you know, you have to look into the analytics behind TikTok in terms of potentially what could be pushed out to users who use it. This is a big concern amongst lawmakers because of the fact that so many young Americans actually get their news from TikTok. So maybe they clip, you know, a segment, Tom, of you talking about something wonky they want to learn about, and in those 15, 20 seconds on TikTok, they learn about it searching something for Bloomberg. But all kidding aside, there are inroads into bipartisanship on the Hill when it comes to places like China.
Just want to turn to Senator Manchin and get away from TikTok for a moment. Can I do that? I think I can do that. He spoke to Fox Business over in Davos, Switzerland, Anne-Marie. He said he wants to deal with the Republicans on the debt ceiling. Can you walk me through how this is going to work out and how important that voice might be this year compared to how important it was in the last couple of years?
Well, he's still an important voice, but he's not as important as he was maybe the prior 2 years of the Biden administration, right? Everyone called him President Mansion because they needed his vote, and he was usually this one that was sometimes difficult to get on board. We saw that, of course, with a lot of legislation the administration was trying to get forward. What he's talking about here is maybe setting up a committee to look into the U.S. debt and to work in a bipartisan way, and how they can also make sure that things like Social Security do not become insolvent. But the issue they have here is that the administration and Democrats, for the most part, are not going to negotiate spending cuts when it comes to the debt ceiling. They truly see these two issues as separate paths, and they do not want to negotiate. But Senator Manchin looks open to maybe this Senator Romney idea of setting up a committee to look into this, but this is going to be a really difficult fight. I know I say that and the markets are shrugging it off, and it is very early right now. Of course, we're going to have the Treasury going into the special accounting measures, but in the summer, this is going to come to a huge fight between the Republicans and the Democrats, and it's a divided Congress. And really the worry is that this becomes to the brink so much that we could, I'm not going to say default, but potentially another downgrade like 2011.
The key word there, early. It's too early. TK, I get the same response from everybody I speak to about this on Wall Street. The investment community is just like, here we go again. It's too early for me to care about.
Here we go again to me is
too early for me to care about.
Yeah.
And ultimately, they will obviously care a little bit more as we get closer and closer to
the next
summer.
hour. Surveillance exclusive.
We'll dive into it. We'll dive into it a little bit more in about 4 months.
Yeah, that's where I am. I totally agree. We're way ahead on this, but the fact is it's percolating, and we've got some smart discussion coming up.
AMH, down in Washington. Anne-Marie, thank you. As always, thank you very much. That smart conversation discussion with Mr. Dudley.
I mean, this is serious, folks. I want to hear from you. I just did TikTok Joe Manchin is a search. I mean, Stephanie Rule comes up and every other news media type. And
they're all on TikTok.
John, are we missing something? You and me on TikTok? I think it'd be great.
On Top Tick.
Top Tick,
Top Tick, I think, is something else.
The tots are on TikTok.
I can tell you this, from what I understand, the version that they get in China is very different to the version that we get in the United States, particularly for young people and how they consume a lot of the information on that app, Tom. And you said something earlier, and I want to clarify it. It's not that Washington, D.C. hates China. It's that much of Washington, D.C. hates the policies coming out of the Chinese Communist Party. And I think that's an important distinction, TK.
Yeah, it is. This goes back, of course, to World War II and the formation of the communist society within the powers of China as well. And there's a lot of ghosts here that go back. And, you know, I had the privilege of living some of that, not only on Formosa, becoming Taiwan, but just there's a lot of nuances here that I think a more modern dialogue misses that leads to that bipartisan angst.
Yeah, I would go further as well. I think there's a frustration with multinationals, particularly in the West, and a degree of hypocrisy, who have one view on things that take place at home and another that take place in other regions.
Anne-Marie led, they got to get business done.
Yeah. Futures right now on the S&P. We're down by about 0.7% on the S&P 500. The sell-off over the last couple of days continues.
ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
A special Wall Street week from the World Economic Forum in Davos, Switzerland.
This is Bloomberg Wall Street Week. I'm David Weston.
Join Bloomberg's David Weston as he engages with the foremost business, political, and cultural leaders for discussions on wealth inequality, global power dynamics, and more. Accountability, solution-driven conversations, data insight. This Friday at 6 p.m. Eastern, only on Bloomberg Television and Radio, your global business authority.
Couple of hours away from economic data in America. Jobless claims coming up a little bit later this morning. Good morning to you. Equity futures on the S&P and the Nasdaq shaping up as follows. On the S&P, we are negative 0.75%. Looking at session lows now. On the Nasdaq, we're down about 8 or 9/10%. The Nasdaq yesterday snapped a 7-day winning streak, believe it or not, the longest going all the way back to 2021. So a little softer this morning off the back of some weak data in the past 24 hours. Will that be confirmed by jobless claims a little bit later? In the bond market, 2s, 10s, 30s in the Treasury market look a little something like this on a 2-year, just north of 4%, 4.078% on a 2-year. After coming very, very close intraday to 480 in the last few months, we've backed all the way away from those levels. On a 10-year, 433, 434, the intraday highs of the last 12 months. That was back